Hello friends, today we are going to go through the AFM May 26 paper booklet on case studies. I think there are about 56 case studies. Some case studies were I think are similar to a May 25 booklet, but I think we will do everything afresh again, so don't worry about that. We'll do it comprehensively. Yeah, as I said, there are 56 case scenarios. Now these are not very detailed case scenarios, these are fairly simple, but some of them have wrong answers also, so please be aware. We are going to solve the right way. Even if there's an incorrect answer, I will highlight it to you and I will tell you where the mistake is made by ICAI. If you have any queries, of course, you can feel free to reach out to me. So, and please do like, share and subscribe to our channel. Please do, refer your friends to us. In fact, quite a few of our students have scored successful marks in the last few attempts. In fact, in Jan 26, we had AAR1, Diksha Goel studying from me, right? So, with that out of the way, let us now start off right away with the first case scenario. This is a small one and there are multiple questions. I think there are 5 to 6 questions for most of the cases. So let's start off. So equity research have estimated rate of returns of stock A, B and market portfolio under each state of the economy as under probability rate of return stock A, B and market. The risk-free rate of return is expected to be 8%. Covariance between A and market portfolio is 122.7. Covariance between B and market portfolio is 125.4. Assume that the CAPM framework is valid in this market and from the given information choose the correct answer. The expected rate of return for stocks A and B. This is very simple. Yeah, this is just a product of these two. 0.3 into 16 is 4.8. 0.4 into 14 is 5.6. 0.3 to minus 9 is minus 2.7. So you add all of this, this is 2.1 and this is 7.7. Okay, stock A is 7.7. What is stock B? 19 into 3 is 5.7. 16 into 4 is 6.4. 7 into 3 minus 2.1. So this makes it 6.3 plus 5.3 plus 5. So this makes it 4.3, these two, and 5.7, which is 10. Yes, so the correct answer is C, 7.7 and 10%. Okay, next, what will be the variance of the market portfolio? What is market portfolio variance? So they have given market portfolio under 3 scenarios. Right, now how do you find out sigma x minus x bar whole square into pi or into probability is basically your variance, under root is your standard deviation. Here they are asking what is the expected return in case of the market portfolio, and from that you have to compute the variance. So what is the expected return? 18 into 3 is 5.4. So see, basically I am solving this like I would have solved in the exam. I am not drawing detailed steps and all, because that you need not do that even in exam, right? Because it's an MCQ, right? 18 into 3 is 54, 15 into 4 is 6 and 8 into 3 minus 2.4. So this makes it 3 plus 6, 9. 9 is the 9 is the mean. So sigma x minus x bar, that is 18 minus 9 whole square into 0.3 plus 15 minus 9 is 6 square into 0.4. Then minus 8 minus 9 is minus 17. So minus 17 square into 0.3. So 9 nines are 81. 81 into 0.3 is 24.3. 24 into 0.4 is 9.6. 17 is 289. 289 into 0.3, 86.7. So if you add all of this, 86.7 plus 9.6 plus 24.3, you get 120.6. Is it there here? No, we got a slightly different answer. Somewhere I must have made a mistake. See, this is where I made a mistake. 6 6 are 36. 36 into 0.4 is 14.4. It is not 9.6. 14.4. 14.4 plus 24.3 plus 86.7. 125.4. See, that is where you have to be careful. Use calculator. Don't try to be over smart like what I did. Okay, anyway, moving forward. What will be the beta of the stock A and B respectively? What is beta? Beta is R standard deviation x by standard deviation of the market, or it is covariance with of the individual security in market by market variance. So this will be, they have directly given 122.7 divided by market variance. We found out, no, 125.4 is for A, and for B is 125.4 is the denominator. Numerator is how much? 125.4. So answer is 1 for B, and 122 by 125 122.7 by 125.4, you get 0.9785 and 1. So answer is C. For question number 3, answer is C, right? Because this is 0.9785 and this is 1. And this is 1. Next, required rate of return on stock A and stock B. What is required rate of return? Expected return is equal to risk-free plus beta into return of the market minus risk-free, which is, so let me do this for stock B, no? Because stock B, most of them have independent values. So it will be easier to check. Okay. Expected return of stock B is risk-free rate is how much? 8% plus beta is 1. Market return, we just now found out expected market return. Where did we find out? 9 is the expected market return. No? We got it here. Plus 9 minus 8. So 8 plus 1, it is 9. So the answer is either A or C. Now we have to figure out this 9785, 9875. So you have to necessarily do both of them. Expected return of A is equal to 8 plus 0.9785 into 9 minus 8. So this will be 8.9785. So the answer will be A. Correct answer is A for question number 4. Okay, then which of the following statements is correct for purchase or sale of stock A and B? Stock A has positive alpha and stock B has negative alpha. Okay, what is alpha here? So this is expected return is 8.9785 and what is the actual return? Actual return is 7.7 and 10. 7.7 and 10 and this one has 9. Stock A has negative because expected return is only 9, actual return is 10. So this is ulta. So stock A have positive, no, stock A has negative alpha, correct, and stock B has positive alpha, correct. This means stock A is overpriced and stock B is underpriced. So sell stock A and purchase stock B. Answer is C. Answer is C for question number 5. The expected return is 8.97, actual return is 7.6, so you have negative alpha. So stock A has negative alpha. Okay, let us move forward. Let us move to the next case scenario. What is the next case scenario? Steady mutual fund has following assets in schemes: Star Gold at the close of business, A, B, C, D, shares and price. Total number of units is 20 lakhs. The scheme Star Gold has accrued expense of 2 lakhs and other liabilities of 2.5 lakhs. From the information given above, choose the correct answer. Gross value of the scheme. What is gross value? Basically, I think they are referring to assets under management. So 20,000 into 25 is equal to M plus, 30,000 into 350 is equal to M plus, 38,000 into 290 is equal to M plus, 50,000 into 400 is equal to M plus. Memory recall 420.2. So the correct answer is B, 420. Total net value. What is net value? Net value is you have accrued expenses, so they have to be subtracted. So 420.2 minus 2 and other is minus 2.50 minus 4,50,000. Makes it 415.7. 415.7. Answer is C. B and C. Okay. B and C. Then NAV per unit. NAV is based on net value. So 415.7 divided by how many units does it have? By 20 lakhs. 20.785. Answer is 20.75. Very simple. We'll move forward. Let us move to the next one. Mr. X, an investor, buys stock of WL Limited worth 21.6 lakhs due to very strong fundamentals. Since last 3 months, the market sentiment is weak and witnessed a significant volatility and considered to remain weak for about next 3 months. Keeping in mind volatility in the market, Mr. X is planning to hedge his portfolio in the futures market. The beta of WBL stock is 1.3 and the current value of Nifty is 2250 and 3-month future is 2310. Current market price of WBL is 240. Each Nifty can trade in units of 240. Assume there is no transaction cost. From the information given above, choose the correct answer. There is no transaction cost and mark to market margin also. Okay, so basically this is about hedging and contracts. So what is the beta? Beta is 1.3. See, what is the goal? Beta of portfolio into value of portfolio is equal to beta of stock or beta of Nifty into value of Nifty. This is what you want to do. What is beta of stock? 1.3 into what is the value of the portfolio? 21.6 lakhs. That should be equal to beta of Nifty. Beta of Nifty is 1. And each future is selling at 2310 into 240 into 2310 into how many units? 240 units into number of lots. Okay, so number of lots is equal to, or number of contracts is equal to 21,60,000 divided into 1.3 divided by 2310 divided by 240. You get 5.06. So 5.06. If you, because you have the portfolio, you have to sell futures. If you have to sell futures, you have to sell 5.06. You should sell 5 future contracts B. To sell 5 future contracts B. Then, so now next question. If the Nifty index falls by 10% from 2250 to 2025 and WBL falls to 212, what will be the net gain or loss? See, what is original WBL price? Originally, I think the price was, WBL is 240. So, WBL price is 240. And how much did we invest actually? We invested 21.6 lakhs, or this investor X. So, 21,60,000 divided by 240. So, they purchased initially 9,000 shares. Okay, long on 9,000 shares and short 5 futures contracts. Please don't forget that. So, Nifty fell by 10%. Here the thing that you have to remember is, when Nifty falls by 10%, the spot, please don't make an interpretation that future also fell. No, this is not the point. What they are actually saying is, after 3 months, whatever is the maturity, 3 months only, no, or 6 months, what is this? 3 months. After 3 months, the Nifty value is 2250 to 2025. That is, Nifty spot after 3 months is 2025. So, futures, what did you enter the future contract into at 2310, right? 2310. So, 2310 minus 2025 is the gain or loss that you will have. 2310 minus 2025. This will be gain or loss, this will be gain because you have shorted a future and the market has gone down. So, 2310 minus 2025 is equal to 285. So, 285 is the gain for how many contracts? 5 contracts, and each contract is 240 is the lot size. So, if you do all of that, 285 into 5 into 240, you will get 3,42,000. Now, what is this? This is gain. But what is the loss? Parallelly, the stock also fell. Stock fell from where to where? From 240 to 212. 240 was the price of the stock, no? If you remember, that is how we computed 21,60,000 by 240 is equal to 9,000. So, the stock fell by 28 rupees. So, 28 into 9,000. This is the loss that you will have on the stock side. So, 28 into 9,000 will give you 2,52,000 minus 2,52,000. So, what is the net gain or loss? Gain. Gain of how much? 90,000. So, here net gain of 90,000. This is the answer, option D. Now, coming to the third part. Nifty rises by 6%. This is exactly ulta. Here what will happen? On futures, you will have a loss. How much is the loss? You shorted when it was 2310, it is 2385. So, 75 rupees loss. 75 into 5 into 240. 5 into 240. That is 90,000. So, the loss on Nifty is 90,000. Loss on Nifty is 90,000. But what about the gain on stock? On the stock has gone to 255. So, 255 minus 240 is 15. 15 into 9,000. 15 into 9,000, 1,35,000. So, there you have a gain of 1,35,000. So, what is the net profit here? The net profit is 45,000. So, the answer is net gain is 45,000. So, these are the answers. Okay. Now, let us move to the next question, case 4. Next is case scenario 4. What is there in this? ABC Limited, a UK firm, is receivable of 20 million due in 6 months. The company wants to cover full exposure. Following information is available. Spot rate is $1 is equal to so many pounds. Okay, what is the base currency here? Base currency is dollar. And this is bid, this is ask. 6 months forward rate is $1 is 0.7910 and 0.8040. Interest rates are as follows. UK is so, US is so much, UK is so much, deposit and borrowing both are given. Following options are pound are available. Strike rate price for call and put. ABC has forecast the spot rate for 6 months as follows. There is a probability weighted number and the information given about choose the correct answer to the following questions. What will be the total expected value of option hedge in pounds? The full exposure is 20 million is covered. So, our fellow is what? Receivable. Our fellow is a UK fellow. He has a receivable of $20 million. So, basically, he is an exporter. He is an exporter. He is exported to US and US is paying them in dollars. That dollars he has to convert it into pounds. So, his goal is to sell dollars and buy pounds. If he is selling dollars, base currency is dollars, banker bids to buy the base currency. So, he is selling dollar, banker is buying the dollar. Right. So, bid quote is relevant. Now, what is the question? What will be the total expected value of option hedge in pounds if the full exposure of 20 million is covered? So, he has to sell dollars. Now when he is selling a dollar, what option is relevant? Call or put, because when you are selling a dollar, you're not buying a pound, you are selling a dollar, you are going to get pounds. So you are going to agree on a rate for pound. So a put option is relevant because that is what you are going to enter into to sell a dollar and buy a pound. So 0.81 into your 20 million basically makes it 16.2, but that is not there. What is the reason? So now it is at spot rate, forward rate, option. Now what has he said? What will be the expected value of option hedge in pounds if full exposure of 20 million is covered? So you see, what is the mistake here? You are supposed to compute expected value of option. Now this is the probability of what is going to happen. So at 0.78, you have a right to sell a dollar and get 0.81. Okay, I have a right to sell a dollar and get 0.81 pounds. Now, if the market rate is 0.78, okay, with 30% probability, will you exercise the option? Yes. When you exercise the option, what will be the value? 0.81, because that's what you agreed. Same way, market is 0.81, your is also 0.81, this also you will get 0.81. But here, will you exercise the option? Because in market you have an opportunity to sell a dollar at 0.83 pounds. So you would rather go with the market. So here it is 0.83. So you cannot directly take. I initially presumed that they were asking what is the value of currency that you will get if you exercise the option. No, that is not what they said. They use the word total expected value of the option. Please be very clear. Expected value. So what is expected value? Is 0.81 into 0.3. 0.81 into 0.5 and 0.83 into 0.2. This will give you the expected option value on maturity given these three rates. Okay, 0.81 into 0.3 is equal to M plus, 0.81 into 0.5 is equal to M plus, 0.83 into 0.2 is equal to M plus. Memory recall, you get 0.814, 0.814. This into 20 million, 20 million. 16.28. So it's not 0.83. This is 0.83 only. 16.28. Now 16.28 is also not here. What have they considered? They have 16.125, 16.5, 15.88, 15.7. What have they considered? Acha, they have also have a price here. So that price also they are adjusting. So you see, you have 20 million into 0.02. So 20 million into 0.02. 20 million into 0.02, you get 400,000. So this is 400,000 pounds is your outflow. Okay, so 16.28 is what you will get minus 400,000. Okay, 16.28 million. So 0.4 million. So 15.88. Wow. What a question. How many complications. And I was solving along with you thinking that, what is the value of the option or what is the value of the exposure per the option? No, wrong. What is the expected value of the option? Partially correct. Expected value of the option minus the premium paid. That is what they are looking at, 15.88. Very tricky, very twisted question. Then ABC is using forward hedge. What will be the total procedure? This is super simple here. Forward hedge is what? This much. Forward may bid or ask. Everywhere I said bid is relevant. So 0.79. So 20 into 0.791. You get 15.82. 15.82. Okay. Okay. Then what is the expected spot rate at the end of 6 months and expected cost if no hedge strategy is adopted? So what is the expected spot rate? Expected spot rate is nothing but a simple probability weighted average of these three. That is 0.78 into 0.3 is equal to M plus. 0.81 into 0.5 is equal to M plus, 0.83 into 0.2 is equal to M plus. Memory recall here 0.805. So it is 0.805. That is the correct answer. And expected cost if no hedge strategy is adopted. So this into 20, 16.1. This is the answer. Answer is option A. Then identify which option gives the highest proceeds. So now if you see this, if you go with the option, you get 15.88. If you go with the hedge, you get 16.10. Okay, if you don't hedge, if you go with forward 15.82, if you go with no hedge, it is 16.1. Correct only, no? These are three options. Now, why do this deposit rate? They are not required. You only need option, forward and no hedge. So 16.1 answer is best is no hedge. Don't do any. Hey, we haven't checked money market hedge. If money market hedge gives you a better rate, then you can consider it. Huh? So that is why they have given the interest rates. Okay, money market hedge. Can you do money market hedge? How will you do money market hedge? You will, because you're going to get money in dollars, you're going to borrow now in dollars and convert it into pounds. If you're going to borrow, you'll borrow some X money. You put it in pounds and then repay the dollars. So you have to borrow 20 million by 1 point, you're going to borrow in US, right? 6%. 1.03. Right, 6% is per annum. This is for half year, right? 20 million divided by 1.03. You borrow 19.417475 million. This you convert it into pound today itself. So what is today's rate? 0.7720 into 0.7720. You get 14.99029. Then when you get this 14.99029, you put it in a deposit. Deposit is in UK. UK deposit is 5.5. So into 1.0275, you get 15.4025 million pounds. So this is not useful. Why? Because you're going to get only 15.4, whereas in no hedge, you're getting 16.1. So yes, no hedge is the better answer. Even though they give money market hedge, you have to quickly be able to solve this. Okay, if you take, draw all the diagram, put a table, how much will I get, how much will I pay, then gone. You'll waste a lot of time. Then, P is considering a new project following details: initial project cost, annual projected sales, annual projected variable cost, annual projected fixed cost, project life, cost of capital. Consider cumulative present value factor over 4 years at 10% is 3.169, 11% 3.16. Ignore depreciation, initial project cost and taxation, calculation of two decimals. From the information given above, choose the correct answer. Initial project cost is varied adversely by 10%. What is the percentage change in NPV? Now, if the sales are 4 lakhs and variable cost is 1.6, so 2.4 lakhs is contribution, 0.6 is fixed cost. So 1.8 is profit, cost of capital is 10%. So at 10%, 3.169, 1.8 into 3.169 will give you the present value of cash inflows is 5.7042 minus outflows is 4.8, which makes it minus 4.8, which makes it NPV as 0.9042. Now what are they saying? If the project cost goes up by 10%, so this 4.8 goes up by another 0.48, then your NPV is minus 0.48 is 0.4242. Then what is the percentage change in NPV? NPV percentage change is 0.48 divided by 0.9042. 53.08. See, it is there. 53.085, so 53.09. Okay, then if annual cash flow is varied adversely by 10%, what is the percentage change in NPV? That is, instead of this being 5.7042, it is something else. That is 1.8 into 3.103. You get 5.5854 as inflow, and outflow is 4.8. So minus 4.8, you get 0.7854 from difference from that and 9.9042. Is minus 0.1188 divided by 0.9042, you get 13.13%. Acha, I did this one, 13.138. Oh, I did this for cost of capital. Acha, I did, instead of doing annual cash flow, I did cost of capital by 10%. I don't know why I misinterpreted this, 13.13. Now, what is annual cash flow? Annual cash flow is 1.8 lakhs. So, this 1.8 lakhs reduced by 10%. So, 1.8 minus 0.18 is 1.62. 1.62 into 3.169 is equal to 5.1338 minus 4.8 will give me 0.3378. That is a revised NPV. Original NPV was 0.9042. So minus 0.9042, I get 0.57042. divided by 0.9042, the reduction is 63.09%. Yes, 63.09%. See, I misinterpreted the question and solved it. Thankfully, it became the answer for the last one. But otherwise, you should not make such mistakes. Next. Okay, let's move to the next question. Fair Return Mutual Fund made an issue of 500,000 units at rupees 10 each on 1st April 24. No entry load was charged. The fund made the following investments, of 49 lakhs. During the year, dividend of 6 lakhs was received on equity shares. Interest on all types of debt was received as and when due. Operating expenses paid during the year amounted to 2,50,000. At the end of the year, equity shares and 10% debentures are quoted at 175%, 90% of the face value. Other investments are valued at par. From the information, choose the correct answer. What is the net cash balance? What is the cash balance? 6 lakhs is the dividend. Okay. Was received. Interest on all types of was received as and when due. So you got 7% on 4 lakhs is 28,000 and 9% on 2.5 lakhs is 22,500. 10% on 2.5 lakhs is 25,000. This is the money, and expenses that you paid is 2.5 lakhs. So 6 minus 2.5 is 3.5. 3.5 plus I think 70. 6 lakhs plus 28,000 plus 22,500 plus 25,000 minus 2,50,000. 425,500. You get 525,500. Acha. So you see 5 lakh units at 10 is 50 lakhs minus 49 lakhs. So they have 1 lakh balance. My God. See, you have to be very careful. Very good question. Nice twist. Then what is the NAV of the fund at the end of the year? See, 5,25,000 you'll add as cash. What about the value of the items? Shares. At the end of the year, equity shares and 10% debentures. Equity shares at 175% of face value. What is face value? 100 each. So 25,000 into 175. That is 43.75 lakhs. Plus, what is the other one? 90% is it? 10% debentures are at 90%. So this is 90% of this is 2,25,000. Okay, and other investments are valued at par, that is these two, which is 6.5 lakhs. So 43, 45, 46, 46 plus 6.5, 52.5 plus you have 5.255, 57.755, 57.755. Answer is C. Good question. The mutual fund distributes a dividend of 0.6 per unit during the year. The NAV at the end will be what? See, 57.755 is the closing value minus how many units are there? You have 5 lakh units. On 5 lakh units, 60 paisa, which is 0.6 on 5 lakhs, which is 3 lakhs. So you subtract minus 3 lakhs. So 57 lakhs, 75,500 minus 3 lakhs, you get 54,75,500 divided by 5 lakh unit. You get 10.951. Where is this? Yes, 10.951. So answer is D, C and B. Moving to the next question. HHM and Co. is a famous consultant. Is established following strategy on stock of PLS. He purchased 1 month call option with premium of 25 and an exercise price of 750. Purchased 3 month, not 1 month, 1 3 month. Okay, my bad. And 1 3 month put option with the premium of 8 and exercise price of 600. Currently selling at 680. Option size is 100. From the information, choose the correct answer. Net gain or loss if the stock price remains at 680. When they ask net gain here, you are referring to the overall portfolio. What is the premium that you have paid? You have paid 33 as premium. Into how many options? Into 1. Option size is 100 shares. So into 100, both of them are purchase only. So you paid 3,300 is your premium outflow. Okay. Now it is currently at 680. What is the net gain if the stock price remains at 680? So if your stock price is at 680, your buy call is at 750, your buy put is at 600, both of them won't get exercised. So you will make a loss of 3,300. Then what is the net gain if the price of the stock falls to 500 after 3 months? So after 3 months, 500. What is after 3 months? It falls to 500. If it falls to 500, your put you will make money. How many? 100 rupees you will make. 100 into 100, 10,000. 10,000 minus 3,600, 6,700. So answer is gain of 6,700. What is the net gain? The price rise to 820. So on buy call side you will make money. Buy call is at 750. 750 and 820 is 70. 70 into 100 is 7,000. 7,000 minus 3,300 is 3,700. So you will make a gain of 3,700. So answer is A, C and B. Okay, then case scenario number 8. On 3rd April 25, Royal Bank quotes the following: bid and ask, 2-month swap, 3-month points. Okay. In spot transaction, delivered in May after 2 days. Okay. Assume spot dates are 5th April and one swap point is 0.0001. Okay. Calculation up to 4 decimal places. Okay. From the information given, choose the correct answer. Swap points for 2 months and 15 days. 2 months and 15 days is half of these two. That is 60 plus 90 by 2 and 80 plus 98 by 2. See, the difference between these two is 98. Difference between these two is 90. So by 2, because for 1 month you get so many extra. So this is 105 and this is 49 plus 80, 129. So bid is 105, ask is 129. This is the correct thing. Okay, then Forex rate for 20th June will be how much? So 20th June, you'll add bid to bid points. So 84.2525 and 1 point is 0.001. So this will become 0.01. So 0.0105. This makes it 84.2630. 84.2630. Answer is C. One of them you do, you'll get everything. The other is automatic. On average rate, the annual rate of premium. So on the average rate on Indian dollars will be, Indian rupees will be. See, now you see, they're asking you what is the premium or discount. So first of all, what is happening? Rupee is depreciating. Okay. Now the question is annual rate of premium discount of US dollar on rupee. It will always, dollar will be at a premium, rupee is at a discount. So first of all it is premium. Okay. So the answer is either A or either C. A or C or D. So B is out of question, right? Now it is at premium. Now second thing is, you are now required to find out, right, whether bid may what is the rate and ask me what is the rate. Now you see bid may, and they said on average rate. So what you are expected to do is 105 divided by average of 84.2525 plus 84.2630. 0.01 this much. So what is the average? 84.2525 plus 84.2630 divided by 2. Okay, so this divided by 2. So you get 0.0105 divided by 84.25775. But please note, this is for 2.5 months. So I'll do 0.0105 divided by memory recall. I get 0.00012. So I'll first of all multiply it by 100. Then into 12 divided by 2.5. I get 0.0598. So 0.0598. Now you see, the only one which has 0.0598 is this. I did not do the ask at all. I get the bid, it is fine. That's all. Very simple. Okay. Let's move to the next question, guys. ABC is planning to acquire XYZ and following information is available. ABC number of shares 12 lakhs, 16 rupees per share, 20 times and XYZ 4 lakh shares, 20 is market price and 10 times the P ratio. ABC plans to acquire the whole of XYZ by issuing shares at its market price of 16. It is expected the purchase price of ABC will remain constant after, the price of ABC will remain constant after the acquisition. Purchase consideration is 80 lakhs. How is purchase consideration 80 lakhs? By issuing shares at market price. Acha, so they are issuing 5 lakh shares. So the logic is this. They are issuing 16 rupees into 5 lakhs equal to 80 lakhs. That's how it is 80 lakhs. Calculation of 2 decimals. From the information below, choose the correct answer. Now, if this is 80 lakhs, what do they ask? EPS of ABC before acquisition. What is EPS? EPS is P by E is 20, right? So, market price, PE, EPS. ABC XYZ, right? ABC is 16 and 20, this is 20 and 10. So EPS is 2, this is 0.8. So ABC and XY is 0.8 and 2. So answer is A, first one. Answer is A, first one. Next one is EPS of ABC after acquisition. So you have 12 lakh shares and now you have allotted another 5 lakh shares. So total share count is 17 lakhs. Now what is PAT? PAT is 0.8 into 12 lakhs, that is 9.6 lakhs, and 2 into 4 lakhs, which is 8 lakhs. Both put together is 17.6 lakhs. So PAT is 17.6 lakhs by 17 share. Yeah, by 17 lakhs. 17.6 divided by 17. You get 1.03529. 1.035. So answer is C, 1.04. Okay, 1.03529. 1.04, 2 decimal. Then what is the next question? P ratio of ABC after the acquisition. What is market price? Market price is 16 because they said that the price did not change, whereas EPS is 1.04. So 16 by 1.04. You get 15.3846, 15.38 times. This is the answer. Okay, very simple, nothing fancy. Let's move forward. A and B are two friends. Since B has earned a lot of profit from trading in derivative markets, A is considering speculating on G shares, which is currently trading at 1400 per share, although taking positions in options in stocks of same company. Accordingly, A took the following contract in the options of G, selling one contract of call 2 months with a premium of 70. So this is 70 inflow and an exercise price of 1500 is K. Purchasing one contract, so of 2 month put option, this is call, sell, buy, put, 2 months with a premium of 50, so minus 50 and K of 1200. Now from the information above, choose the correct answer for the following questions. Assuming the contract size of each option contract is 200 and the price of G after 2 months falls to 1100, the net payoff, so size is 200, so 200 into, see, you're getting premium of 70, paying premium of 50, so you're getting net premium of 20 into 200, which is 4,000. This is the gain that you're making. And price of G after 2 months falls to 1100. So if it falls to 1100, you've sold a call option. Will the call option be exercised? No. Somebody has a right to buy from you. They have a right to buy from you at 1500. If market is 1100, they will not buy. Purchasing one contract, so you have a put option, you have a right to sell at 1200. So market is 1100, so you'll buy in the market at 1100, sell it off at 1200, so you'll be exercising the option. So you'll get basically 100 rupees. 100 rupees on how much? On 100 options, right? No, 100 rupees on 200. 100 into 200 is 20,000. So 20,000 plus 4,000 is 24,000. 24,000 is profit. Answer is 1 is B, 24,000 profit. Next, price per share of G after 2 months at which A shall be at break even. Break even is what? At which they make no profit or no loss. Now you see in this question, no, 20 rupees is what you have gained. Okay, now basically this means that you have to lose 20 rupees. When will you lose 20 rupees? See, you have a put option, you will not exercise it when there is a loss. So there is no way that you will lose on put side. So you will lose only on call side. Call also you have sold. That is, the other party has to gain 20. When will the other party gain 20? When the market price is 1520, he will buy from you at 1500. So at that particular point, you make a 20 rupees loss. That 20 rupee loss compensates your 20 rupees gain. Okay, so call option at 1520, that should be the right one. Brilliant. That option itself is not there. I don't know how they have arrived at it, what they have arrived at it. What is the answer they have given? They have said 1200 minus 120, which is 1180. This is incorrect. Answer is absolutely incorrect. If you get incorrect answer, please mark anyone. Ideally you should get marks, or they will add something during moderation. But here the answer is incorrect. It is impossible for anyone to make break even at 1180 because you have purchased a put. If you have purchased a put, if the market is going on at 1180 and you have a right to sell it at 1200, you make a 20 ka profit. That 20 profit and your 20 profit here both becomes 40 profit. Where is the break even? So it doesn't happen. So it has to be, cannot be 1200, it has to be Greater than 1200. At 1220, market is at 1220, you have a right to sell it at 1200. Why will you sell it here at 1200 at a loss? You will not sell it. So, the 20 rupees is still the profit. So, there is no way on the put side that you will make any break even. The break even will all be on the call side. This is a mistake. So, I was telling you guys, if you recollect, that in this particular set of case studies, there are some case studies where they have made mistakes. This is one of those. Neither of them is a correct answer. Correct answer is 1520, where you make a break even on call side. Assuming that the contract side for the East option is 300 and the price of G after 2 months raises to 1600, what is the net payoff? So 300 into 20, you get 6000 as the premium. 20 is the net premium. No, 70 rupees you have received on sell call and 50 rupees you have paid on buy put. Net premium is 20 and you have done 300 options, so you get 6000 as the premium, net premium, as the premium that you have received. Then market price is 1600. So market price is 1600. Somebody has a right to buy from you at 1500 when market price is 1600. So they make 100 rupees profit on how many shares? On 300. 100 into 300 is 30,000. So they make 30,000. So 30,000, this is your loss, this is your profit, net is minus 24,000. So 24,000 loss, this is the correct answer. So answer, option 3, they have given the correct answer at 24,000, but option 2, they made a mistake. Okay, institute is not necessarily 100% right always. Okay, let us move to the next case study. A Limited wants to acquire D Limited and has offered a swap ratio of 1:2, that is 0.5 shares for every share of D. Following information is provided: PAT, equity shares, PE ratio, market price. Now, what else is pending? We'll find out EPS also, no? Somewhere EPS will be used. 15 by 5 is 3, 7 by 3.5 is 2. If this is the case, 3, yeah, here also you can get 72 lakhs by 24 lakhs is 3 and 14.4 by 7.2 is 2. That is also not a problem. Okay, the number of equity shares to be issued by A for acquisition of D. So, for every 1 share, 0.5 shares. So, you have 7.2 lakhs. So, you will issue 3.6 lakhs. So, answer is B, very simple. I don't know why they asked. EPS of A after acquisition. What is the PAT? PAT is 72 plus 14.4, which makes it 86.4, divided by original share count of 24 and then you have 3.6. So, 27.6. So, 86.4 divided by 27.6, you get 3.130. So, 3.13. Then equivalent earnings per share of D Limited would be, what is equivalent earnings per share of D? See, I have got half a share, but for each share it is 3.13. So for half a share it will be 3.13 by 2, which is 1.565. Okay, 1.565. That will be for each share of D. I am getting 1.565, whereas here right now my EPS is 2. So from 2 it has gone down to 1.565. See, 1.565 is there. Okay. So what is this question? If A Limited PE multiple remains unchanged, what is the PE multiple here? PE multiple is 5 times. So 5 into EPS into share count. What is EPS? Revised EPS. Revised EPS is your where did we get revised EPS? After acquisition, 3.13. So into 3.13 into share count. Where do we get the share count here? We had no 3.6 plus 24, 27.6. 5 into 3.13 into 27.6. 431.94. 431.94. This is the answer. Okay, very simple one, nothing complicated. Next, during one business meeting at ABC, one of the members presented data relating to 3 companies, X, Y, and Z, whose operating incomes are equal but capital structure is different. Invested capital is same, 40 lakhs. Debt asset ratio is different. Shares outstanding are different. Post-tax cost of debt is different. Cost of equity is different. And operating income is same. Everywhere EBIT is same. Tax rate is 35% in all cases. Industry P is 10 times. From the following information, choose the correct answer. Weighted average cost of capital of Y. Right? This is Y. So, equity and debt. So, debt to assets ratio. So, overall assets and debt. Right. So, debt by total capital. This basically is debt by total capital. So, if this is total debt by total capital is 50-50. If it is 50-50, cost of equity is 22%, cost of debt is 8.45%, and this into 1 minus tax rate of 35%, and both of them are 50-50. So, 11% plus 8.45 into 0.65 divided by 2 is 2.74 plus 11. Makes it 13.74625. 13.74625. Why is it not there? We don't have anything 13. Is there any mistake? If we don't take tax, what will happen? 8.45 divided by 2 plus 11. 15.225, isn't there? Arey yaar, what is this? Oh, this is post-tax cost of debt, is it? Oh, my mistake. The tax rate is post-tax. So, tax rate is not relevant here. See, made a mistake. So, be very, very careful. I thought it is pre-tax cost. It is actually post-tax cost. This is also wrong. This is correct only. Okay. Then economic value added. What is EVA? EVA of X Limited. EVA is NOPAT minus capital charge. What is NOPAT? NOPAT is EBIT into 1 minus tax rate, 1 minus 35%. So, our EBIT is 10 lakhs, right? 10 lakhs minus 35%, 6.5 lakhs. Okay, capital charge. What is capital charge? Capital charge is WACC into invested capital. Now, so we have to find out WACC for X also. What is WACC? Your post-tax cost of it is 10.4 and your cost of equity is 26. The ratio is 80-20. So, 0.8 into 10.4 plus 0.2 into 26. 13.52. 13.52 into invested capital is 40 lakhs. You get 5,40,800. If you subtract these two, 109,200. Yes, 109,200. This is the correct answer. Then, estimated market capitalization of Y. No, sorry, price per share of Z. What is price per share of Z? How will you arrive at price per share of Z? You have shares outstanding. How will you arrive at price? Invested capital is there. PE ratio. So, you have to arrive at EPS. So, what is EPS? EPS is your EBIT. EBIT is Z mein, EBIT is 10 lakhs. Interest is how much? So, what is the invested capital? 40 lakhs. Out of that, 20% is debt. So, which is equal to 8 lakhs. What is cost of debt? 9.75 is post-tax. So, 0.0975 divided by 0.65. You get 15%. So, 15% is the cost of debt before tax. So, 15% of 8 lakhs is 1.2 lakhs. Right. So, 1.2 lakhs is the interest. So, your PBT is 8.8 lakhs. Tax is 35%. 8.8 into 0.65. You get 5.72 lakhs as PAT. And your share count is how much? Share count is 2 lakhs. Divide by 2 lakhs will give you 2.86 as EPS and 10 is the PE ratio. So, the price is 28.6. Is that an answer? 28.6. Yes, 28.6. Estimated market cap of Y. How do you arrive at market cap of Y? Same logic. You have to do the price per share and then multiply with the number of shares. What is the price per share? Again, you have to do 40% ka 40 lakhs ka 50% is 20 lakhs. 20 lakhs is EBIT is 10 lakhs. Interest on 20 lakhs, you have to charge interest. Interest is at what? 8.45%, but that is post-tax. 0.0845 divided by 0.65. Interest is at 13%. 13% on 20 lakhs. 13 twos are 26. So, 2.6 lakhs. So, your PBT is 7.4 lakhs minus tax. So, 7.4 into 0.65. You get 4.81 as PAT divided by what is the share count? Share count is 1,66,000 divided by 1.66. You get 2.897 as the EPS multiplied by 10 times. You get the price per share as 28.975 into 1,66,000. You get 480,999.99. So, 48 lakh 10,000. So, answer is B. Then EPS of X Limited. What is EPS of X? You have 10 lakhs of EBIT. Then you have 10.4 divided by 0.65. You get 16% as cost of capital. 16% of 32 lakhs into 32 divided by 100. You get 5.12 as your interest. So, you get 4.88 as PBT. Into 0.65 will give you PAT 3.172 divided by 1.22 is your EPS, which is 2.6. 2.6. Okay. Now, let us move to the next question. Let's look at the next case study. Case scenario 13. XYZ is planning to expand its business, therefore raising funds by issuing a convertible bond of 10 crores. An investor is interested in investing in the bond. Is the following data. The given data relates to the convertible bond. From the information given above, choose the correct answer. The conversion value of the convertible bond. What is the conversion value? Conversion value is you have a bond which gets you 20 shares. Okay, market price of each share is 48. So the conversion value is 20 into 48, which is 960. First one. The conversion premium of the bond in absolute terms. What is the conversion premium currently? The market price is 1060, but equivalent value is in share terms is 960, in straight value terms is 940. So the conversion premium is with respect to what? Is it with respect to the straight value, or is it with respect to the market value of equivalent shares or conversion value? So conversion premium is always when a conversion happens, what will happen? So it is always with this 960, not the straight value. So it is 100 rupees is the premium. Okay. Then floor value of the bond, convertible. What is the floor value? What is the lowest that the bond can go to? See, bond can go to 1000, but the current straight value is 940. So the floor value is basically the straight value of the bond. Because face value is not the lowest that a bond can go. Bond can go below face value. So whatever is the straight value, depending on the yields, it can go down further. Right. The potential upside of the convertible bond. The upside potential of the convertible bond primarily depends on coupon rate, face value, market movement of equity shares, and remaining maturity. Absolutely market price of the equity shares. If the shares go up, the upside also increases. By approximately what percentage? So the investor is indifferent between the share from the market and taking the conversion route. So currently the share price is 48 and you are getting it at 960, whereas the market price of the bond is 1060. So 1060 divided by 20. So the share price should go up to 53 from 48. So 53 by 48 minus 1 is 10.416%. So answer is 10.42%, 10.416 or 10.42. Right, next case scenario. A Limited paid a dividend of 5 for last year. The dividend is expected to grow at 25% for the next 6 years and 10% per annum thereafter. The standard deviation of the market return in A shares is 12% and of market return is 12 and A share is 18. Okay. The correlation between market return and A share is 0.3733 and the return of the government bond is 13%. Market return is expected to be around 20%. From the information, choose the correct answers. Beta is equal to R standard deviation X by standard deviation of market. R is what? Correlation is market is 12 and A is 18. So 18 by 12 into correlation 0.3733. .55995. 559 is 56. So this is the answer. Next, what is the equity risk premium as per the given data? What is equity risk premium? Return of the market minus risk-free rate. Market return is 20%. Risk-free rate is how much? 13%. So it is 7%. See, 7%. Valuation approach is used to compute the intrinsic value. So you have how many things? Dividend expected to grow at 25% for 6 years and 10% thereafter. So it's a single stage. No, it is a dual stage or single stage. It is a two-staged model. There is no CAPM valuation model. No? There is no CAPM, it's two-stage. If the market price is higher than the intrinsic value, that the genuine true fair value is lower and market price is higher, then the share is said to be overvalued. Okay, then case scenario 15. Following information available with respect to bond X and Y. Face value redeemable at par 1000, 6%, 10%, time to maturity 5 and 3. Mr. Y, an investor, has made as portfolio consisting of 75% of X and 25% of Y. The current YTMs are 10%. From the information given above, choose the correct answer. I think this is one of the past paper questions. At prevailing YTM, bond X will trade. See, bond X is what? Coupon rate is 6%. Current market rate is how much? 10%. So if the yield increases, price falls. So price will fall. So it will be trading at a discount. Then Macaulay duration of the bond. What is Macaulay duration of the bond? Macaulay duration is the modified duration is sensitivity. Macaulay duration is the average time taken in present value terms to recover the full value of the bond. So weighted average time to receive the cash flows. Yes. Answer is B. Okay, then Dash carries higher interest rate risk. Which kind of a bond has higher interest rate risk? A bond with higher duration has higher interest rate risk. Now, which bond has higher duration? Now, it is very difficult to figure out based on this. See, higher coupon rate is lower duration. Lower coupon rate is higher duration. Same way, higher maturity is higher duration. So, these are inversely related. So, this implies higher duration. This also implies higher duration. So, bond basically X has higher duration because higher the coupon, lower the interest rate risk, right? Because you will receive the money faster, right? Whereas lower the coupon, you will receive the money later. So, which is higher duration. Whereas longer the maturity, then obviously duration is higher. Bond X. Then investor wants to reduce interest rate risk of the portfolio. He should do what? If you want to reduce the interest rate risk is what? If the higher the duration, higher the interest rate risk. So, if you want to reduce the interest rate risk, you should increase the weight of the bond which has lower duration. So, bond Y has lower duration. So, bond Y currently is 25%. So, you should increase it. Increase weight of bond Y. Answer is B. A and B. Okay. Then following information is related to actions taken in different situations of financial options. You have exercised. So it is option. So there is no forward, future, long, short, nothing. Okay. This is from a study exam question. That's what I'm saying. Exercise price is given, premium is given, spot price is given. From the information given above, choose the correct answer. Investor incurs a loss equal to premium paid in situation. Which situation? Premium paid is 400. So, and you have exercised it. See, exercise price is 2,800, spot price is 3,200. What kind of an option is it where you exercise when the current market price is higher than the exercise price? A call option, because you have a right to buy it at 2,800, sell in the market at 3,200, and the gain and loss are matching each other. So, in situation 1, incurs a loss equal to premium paid. This is not a loss. Here you make a gain equal to premium paid. This is actually a buy call, right? This is a buy call from your perspective. Let's say the other party exercises the sell call. Right, if you have bought a call, somebody else is selling a call. So, when market is at 3,200, they have a right to buy from you at 2,800. So, at that particular point, you incur a loss of 400, but that is equal to premium paid. So, it can actually be buy call or sell call. No? So, it is just a call. So, loss equal to premium paid is situation 1. See, in situation 2 and 3, this is 500 and 300 not matching, 8,000, 6,000 not matching. So, it is only in situation 1. In which situation the option is classified as in the money? Correct. This is where it is in the money. Why? Because I have a right to buy. This is a put, boss. See, in both the situations, it is in the money only because it differs on perspective. In both the situations, in the money only because in case of a call, somebody has a right to buy 2,000, market rate is 3,200. In case of a put, it is exercised. So, somebody has a right to sell it at 4,000, market price at 3,500. So, both the cases, option situations 1 and 2 is in the money. Then in situation 2, the intrinsic value of the option. What is intrinsic value? Intrinsic value is basically a difference between these two, which is 500. Dash represents a break-even outcome for the investor. So, only situation 1 is break-even outcome. And relationship between spot price and exercise price in situation 2 indicates what? It's a put in the money. Now, in question 1, right, I think I made a mistake. Loss equal to premium paid. So, they are saying premium paid, not premium received. I misread it as premium received. Somebody has paid a premium and that is the loss. Meaning, they have not exercised. Meaning, it is lapsed. Meaning, it is option 3. It is not situation 1. It is actually situation 3. My mistake. I realized it only when I saw the answer and I reread the question. Loss equal to premium paid. Okay. So, be very, very careful. See how I could have unnecessarily landed in trouble if I had not checked it again. Right, please be very careful. Moving to the next question. Company ABC proposes to take over XYZ Limited. The chief executive of company thinks that stakeholders always look for earnings per share. Therefore, he considers maximization of EPS as objective. The following information is available in respect of ABC and XYZ. Net profit, PE ratio, current market price. The company is planning to borrow funds at 15% and buy out the target company by paying cash. Tax rate is 30%. Information given above, choose the following. First of all, they said net profit and current market price and PE ratio. So, if market price is there and PE ratio is there, then EPS is 840 divided by 10.5. This is 80 and 1700 by 10 is 170. If this is the EPS and this is the net profit, then share count. Share count is 400 lakh by 80 lakhs is 5 lakh. 400 by 80 is 5 lakhs and 315 divided by 170. 1.85294 lakhs. Total value of equity of XYZ, market value of equity, which is your P ratio into your net profit, right? That is 3150. If XYZ is borrowing funds at a high interest rate to finance the acquisition, it will affect EPS mainly due to what? Very, very high interest, it will affect due to increase in interest burden. B, it is not about the increase in market price or tax liability. If ABC is offering about 4030 lakh to XYZ for the proposed acquisition, it will result in what? EPS accretion, dilution, no change, or risk-free EPS. What is this whole risk-free EPS nonsense? So you are basically paying 4030 lakhs. How many shares are you getting? You are getting 4030 and you're going to pay in cash, right? Okay, you're going to pay 4030. Now, what is the share count? What is the PAT? PAT we have is 400 lakhs and you have 315 lakhs, so total 715 lakhs. This is the PAT. But you also have interest. Interest on how much? 4030 lakhs at 15%. 4030 into 0.15. You get 604. But that is pre-tax. Post-tax is into 0.7 is 423.15. 423.15 is the interest. If you subtract these two, you will get minus 700, you will get 276.85. And what is the share count? Share count is, we computed here, 5 lakhs. Divide by 5 lakhs. Divide by 5 lakhs, divide by 5, you get 55.37. What was the old EPS? Old EPS was 80. So obviously there is a EPS dilution. Then A Limited is planning to borrow an amount of 300 crores for a period of 3 months in the coming 6 months time from now. For a period of 3 months after 6 months, FRA. The current rate of interest is 9% but is likely to go up in 6 months time. The company wants to hedge itself against the likely increase in interest rate. Because CFA have been asked to suggest both traditional as well as modern methods to hedge interest rates. Suppose the banker has quoted the following forward rate agreement rates. A Limited has already issued renewable bonds or debentures. From information given above, choose the correct answer. What do you mean he has already issued? I don't know. If in an FRA contract, the company intends to borrow funds in future, should buy FRA at bid rate, buy FRA at offer rate. See, first of all, they will buy FRA, boss. When you are buying, that is the rate, what is the bid and ask? They have given two rates, right? Now, you are buying the FRA because you are going to borrow. Now, when you are borrowing, you will always pay a higher rate. So, the ask is what is relevant. Buy FRA at offer rate. If interest rates rise above FRA, A Limited under the FRA will receive compensation from the banker. Answer is very easy. If interest rates go up, I am smart enough to have entered into a contract, so I will make more money. The settlement and FRA is made at the end of the loan period, beginning of the loan period, maturity, or along with repayment of principal. No, it is made at the beginning of the loan period at present value terms. B. Then FRA settlement is discounted because interest rates are earned, FRA is settled in advance, principal not exchange, only interest differential is paid. It is discounted because FRA is settled in advance. It is not settled on the date of loan repayment. Interest rate futures differ from FRA because futures are OTC instruments, tailor-made contracts, standardized and exchange traded. Yes, standardized and exchange traded. Okay. Then ABC Inc., a US firm, will require 600,000 pounds in 6 months. Is evaluating different strategies to hedging its currency risk. The available market data is as follows. Current spot rate is a pound is equal to $2.50 and 6 months forward rate is $2.45. Interest rates are given: deposit, borrowing, UK, USD. Option contract, call option available in dollar, expiring 6 months with exercise price of 2.46 and premium of 0.05. They have forecasted following probabilities. From the information given above, choose the correct answer. I think we have solved a very similar kind of question. Anyway, since ABC will require 600 in future, it is said to be, it will require in future, right? Because we earlier solved, I think, an export receivable. Here, US firm will require. So, there will be short pounds. B. Answer is short in pound. Under forward contract, dollar cost of 600,000 pounds is. So, forward contract, 600,000 pounds, 600,000 into 2.45 is 1.47 million. So, they are saying certain but flexible, uncertain but capped, certain and fixed, and nil. It is certain and fixed. It is not uncertain and capped, it is certain and fixed. Which hedging technique allows ABC to benefit if the pound depreciates while protecting against appreciation? Is it a forward, money market, call option, futures? It is an option. Option only protects you on one side, whereas both forward and future will hit you on either side. You may get a profit also, you may get a loss also. Money market hedge is, again, it's equivalent to a forward hedge, so that doesn't work out. If the spot rate after 6 months happens to be 2.39 pounds per dollar, dollar per pound, then ABC under option hedge will do what? See, I am somebody, I need to buy pounds. So I will buy a pound by giving $2.46 per pound. So after 6 months, if the pound dollar rate is $2.3 per pound, I would rather buy, because I'm an American company, I would pay lesser dollars. So I would actually let the option lapse. Okay, which of the following hedging methods involves borrowing and lending two currencies simultaneously? Money market. See, next. An investor is evaluating two companies X and Y to determine which company is better investment. Both companies have different expected returns, standard deviation beta. X has an expected return of 22% and a standard deviation of 40%, beta is 0.86. Y has an expected return of 24%, standard deviation of 38% and beta of 1.24. Correlation coefficient between returns of X and Y is 0.72. Standard deviation of the market return is 20%. Given the information, choose the correct answer. Which company is expected to be more volatile in absolute terms? Who has higher standard deviation is more volatile? Standard deviation is 40% and standard deviation is 38%. In absolute terms, what do you mean absolute terms? Standard deviation is overall risk. So answer is A, 40% only, X. A, 40% X. The correlation coefficient of 0.72 between X and Y implies what? If there is a correlation between those two, they both are moving not perfectly correlated, strong positive co-movement. Yes. If correlation between X and Y were 0, portfolio risk would definitely decrease. Portfolio risk will not become 0, but portfolio risk will definitely decrease. Which type of risk can be reduced by forming a portfolio? So usually when you do diversification, you are reducing unsystematic risk and not systematic. So political, market, interest rate can be diversified. Unsystematic risk, political, market, interest rate cannot be diversified. Unsystematic risk can be diversified. If volatility increases but betas remain unchanged, the expected return as per CAPM. See, market volatility is increasing, market standard deviation. Betas are unchanged. Okay, betas are not changing. Then expected return as per CAPM. How will CAPM return have anything to do with volatility? CAPM return is independent of all of those. See, there is a component of standard deviation, but then if beta is remaining unchanged, then in your entire CAPM equation, beta is same, RM is same, RF is same. Why will there be a change in return? There will not be any change. So it will remain unchanged. ABC plans to invest 16 lakhs in a new unit. The project is expected to have useful life of 4 years with no salvage value at the end of its life. The annual depreciation is 4 lakhs. Projected revenues and costs ignoring inflation are given below. ABC is subject to corporate tax rate of 60. Cost of capital including inflation premium is 10%. Then depreciation provides a tax benefit and inflation rates for revenues and costs are given below. From the information below, choose the correct answer. Inflation adjustment of revenues and costs is required mainly because cost of capital includes inflation, tax rate is high, depreciation is constant, and project life is short. See, cost of, why are we adjusting revenues and cost for inflation? Because if your cost of capital also includes inflation, you have to necessarily ensure that both the numerator and denominator, everything has inflation. Tax rate has no logic. Project life is short, that is also not logic. Depreciation is constant. How is that related to revenues and cost and inflation? So answer is A. Then if inflation were ignored in cash flows but included in discount rate, the NPV would be, so cash flow is not high but discount rate is very high, so NPV would be understated. Which of the following cash flow is not affected by inflation? Revenue, operating cost, depreciation, tax payment. See, other than depreciation, everything else is affected by inflation. Depreciation is at historical cost. Right, now see the point in this entire question, nowhere of the, entire case, none of the case matter aspects are relevant to the questions that are asked. Very weird. Then, X and Y are two friends. Since Y has earned a lot of profit from trading in financial derivatives, X is also considering speculating on Gamma Corporation shares, which is currently trading at 700, though taking positions in options of the same stocks of company. Currently, X took following positions on options of Gamma, purchasing one contract of 2-month call option with a premium of 35, purchasing one contract of 2-month put option with a premium of 25. So both are buy. So you paid $60 as outflow. Then, after some time in option market understand nitty-gritties, X being CEO of an organization raised team to implement the concept of financial options in the capital budgeting decision called real option. From the information, choose the correct answer. Assuming the contract size of each option is 100 and the price of Gamma shares after 2 months falls to 550. So, if it falls to 550, I have a right to sell it at 600. So, I make a profit of 50. 50 into how many? 100. 50 into 100 is 5,000, whereas here I have lost 6,000. 5,000 gain and 6,000 loss is net 1,000 loss. Okay, then the per share price of gamma copy stock after 2 months at which X shall be break even. So break even can be on either side. See, both on call and put. I have a right to buy it at 750. So if it goes above 750, I have to make 60 bucks more. So it has either 810 or I have a right to sell it at 600. So it has to come down to 540, 810 or 540. Answer is 540, 2A 540, one of those, because it's both buy, right? So both ways you will have a option. In one of the previous questions where there is a sell of a put or something like that, then there was no opportunity. Which the following statement is true, false, not true, false. So the following statement is false regarding real option. Is an approach to capital budgeting that relies on option pricing to evaluate. Yes, this is true. Is integrated intended to supplement, not replace capital budgeting on discount GCF methodology is true. They are different from financial options as their periods start from the end of first year and are higher than financial option. Usually true. They are normally traded. No, they are not traded. Option D is false. Then case scenario 23, given data relates to convertible bond. Face value is 450, coupon 15%, number of shares per bond 25, market price of share is 20, so 500 is the conversion value, straight value 400, market price is 550. Stock value of the bond, we just now computed 500. Percentage of downside risk based on market price of convertible bond. Market price is how much? 550 and the lowest it can go is 400, so 150 by 550. Is 27.27%. Then conversion premium. What is a conversion premium? Conversion value to whatever is current price. Current price is 550 and conversion value is 500. The premium is 10%. Conversion parity price. At what price will the stock will it be same as the current market price of the bond? 550 divided by 25, which is 22. Then Mr. A is interested in investing 1 lakh, for which is considering the following 3 alternatives. Invest a lakh in mutual fund X, lakh in mutual fund Y, portfolio where 60,000 in X and 40,000 in Y. Average annual return earned by X and Y is 12 and 11%. Risk-free rate is 8%, market return is 10%. Covariance of MF, MY and market portfolio are given. From the information you know, choose the correct answer to the following. Standard deviation of MFX. This basically is covariance of a security with itself is its variance. So 4.4 square root 2.0976. Then portfolio return would be, what is portfolio return? Portfolio return is weighted average return. Weighted average return is 12% into 0.6 plus 11% into 0.4. 7.2, 4.4, that is 11.6. Based on standard deviation, optimum investment for A would be what? See, for A, X is, what is X return? 12%, 11%, 10%. X, Y, market. What is standard deviation? Under root 4.4, under root 4.2, under root 4.2. So, which one is better? 12 divided by 4.4 under root m plus 12 by memory recall. You get 5.72 return per unit of risk. 4.2 under root m plus 11 by memory recall. 5.36. 4.2 under root m plus 10 by memory recall. 4.87. So actually based on standard deviation, the optimum investment for A would be all investment in MFX because you get better return per unit of risk. So friends, now let us look at the next question, case scenario 25. P Limited is studying the possible equation of Q Limited by way of a merger. The following data are available. P Limited 10 lakhs is PAT, 2 lakhs is shares, 75 is market price, book value is 210. 3 lakhs is PAT, number of equity shares is 50,000 and market price is 60 and book value is 105. The merger shall be done by exchange of equity shares and the exchange ratio is set according to weights assigned to different bases as mentioned below on EPS, on market price and book value. From the information given above, choose the correct answer to the following questions. The swap ratio based on the weights shall be. What is the swap ratio here? On EPS, we have to find out EPS first of all. What is EPS? Your PAT by number of equity shares. 10 lakhs by 2 lakhs is 5. 3 lakhs by 5 lakhs is 6. So the EPS ratio is 5:6. This is 5:6. We will change it later. Wait. Market price is 75 is to 60, which is 5 is to 4. Book value is 2 is to 1. So now, on basis of this, right, what is very clear, it is very clear that the P company limited or P limited whatever is much stronger. Other than in EPS, everywhere else it is stronger. So if you do this, right, 5 by 6, 5 by 4, 2 by 1. So you get 2 shares, you get 1.25 shares, you get 0.833 shares. So for each share of P, you have to give these many shares of Q. So you multiply 0.833 by 0.5 is equal to M plus 1.25 into 0.25 is equal to M plus 2 into 0.25 is equal to 0.5 M plus. Memory recall, you get 1.229 shares of Q for 1 share of P, right? So 1 by 1.229 gives you how much? 0.8136, 0.8137. Okay, these are the two ratios. Are any of them available? No, this is not available. They are looking at it the other way. That is, don't look at it this way, look at it as, don't look at it this way, look at it other way. That is 6 is to 5, 4 is to 5, 1 is to 2. 6 by 5 is 1.2, 4 by 5 is 0.8, 1 by 2 is 0.5. Multiply this with 0.5, 0.25, 0.25. You get 0.6 plus 0.2 plus 0.125. You get 0.925. So what you give is 0.925. What is this? For every share of Q, you will give 0.92 shares of P. Okay, 0.925. Is this there? Yes, this is there. Okay, so this is the way to do it. Now, some of you may be confused, sir, what will happen if they give this also versus they give this also? You also did the first time with the wrong method, no? How can you do like that? How will we know what is the exact way? See, theoretically, right, theoretically, they should very clearly specify. When they say the swap ratio, they should specify for 1 share of Q, how many shares of P. Then it is easier to compute. But if they give like this, it's actually fairly confusing and difficult. But one way you can actually look at it is, which I told in class also, if the ratio of EPS is 5 is to 6 or market price is 5 is to 4, book value is 2 is to 1, the swap ratio is inverse. So the swap ratio actually is 6 is to 5, that is 6 shares of P is equal to 5 shares of Q, 4 shares P is equal to 5Q, 1 P is equal to 2Q. Now, if this is the swap ratio, then you directly do the division, that is 6 by 5, 4 by 5, 1 by 2. That is more often than not, institute gives answers which can be directly computed like this. So if at all there is a doubt that you have, how should I do? Always follow this method, ratio of EPS, then change it ulta, make it into actual shares exchange. For that you take numerator by denominator. Okay. Next, based on the swap ratio as per assigned weight, total number of shares issued by Q, P to Q shall be how much? P to Q. So for 1 share, you will issue 0.925. How many shares do you have? 50,000. 50,000 into 0.925. That gives you 46,250. Then post-merger, what shall be the EPS of P Limited? What is post-merger EPS? Post-merger PAT, which is 13 lakhs divided by 10 lakh 46,250. 10 lakhs only, no? The previous P's share count, yes. No, 10 lakhs is the PAT. 2 lakhs is the share count. See, that is what it should be. 2 lakh 46,250. 13 lakhs divided by 2 lakh 46,250 is 5.279. 5.279. So answer is this. Then in case Q Limited wants to be sure that EPS is not diminished by the merger, the relevant exchange ratio to achieve the same objective should be. So if you don't want your EPS to reduce, then you should exchange the ratio of EPS. EPS ratio is 6 is to 5. That is, for every 6, every 6 shares of P, you will surrender 5 shares of Q. It looks at 1.2, but 1 by 1.2, 0.833. Is 0.833 there? So they have created a very good problem here. Is it 0.83 or is it 1.2? In case they want to be sure that EPS is not diminished, the relevant exchange ratio to achieve the same objective. Now, what is the exchange ratio? See here, I got 0.833. When I said 0.833, what is it? 0.833 is, what is 0.833? For 1 share of the acquirer, right? Whoever is giving, you surrender 0.833. But is that the ratio? We have got here 0.925. How did we arrive at 0.925? The inverse of EPS. So now also you have to take inverse of EPS, which is 6 is to 5, which is 6 by 5, which is 1.2. So the correct answer should not be 0.833 or 1.2. It should only be 1.2. Please don't get confused. See, the exact point what I was trying to communicate in question 1, we are now again seeing this in question 4. Okay, let us move to the next question. Case scenario 26. Y has invested in 3 mutual funds as per the following details: X, Y, and Z. 4 lakhs, 8 lakhs, 4 lakhs. Net asset value is so and so. Dividend received is so and so. NAV is so and so. Effective yield is so and so. Assume 1 year 365 days. From the information given above, choose the correct answer to the following questions. Total NAV of MFY on 31st March would be how much? What is NAV at the time of purchase? Dividend received. NAV as on so and so. What is the total net asset value? So here we have 10 rupees, right? This 10 into how many, this thing, we have 8 lakhs is what we invested. 8 lakhs we invested at 1.1. So 8 lakh divided by 1.1 is the number of units you have. That is valued at 8 lakhs divided by 10.1 is the units you have, multiplied by 10. You get 792079. Yes, 792079. This is the answer. Then total yield of MFX in terms of rupees would approximately be yield of MFX. What is yield of MFX? 4 lakhs you invested at 10.3. Then you also got a dividend. Then you have closing NAV, effective yield per annum. So now 9.66% on 4 lakhs. 4 lakhs into 9.66% is 38,640. Now total yield in terms of rupees, they've got 38,640, but this 38,640, when did you invest? 38,640 is per annum, but it doesn't appear that this is per annum scenario, no? Because it very clearly, it appears that it is not a per annum. Investment was made somewhere in the middle of the year. So you cannot consider this. What you have to do is, you have to consider absolute value. Absolute value, basically here, you invested at 10.3, yield is 10.35. Okay, so 4 lakh divided by 10.3 into 10.35 minus 4 lakhs. This is the gain that you have made on investment value, plus 9,000. This basically is the money that you have made. 4 lakh divided by 10.3 into 10.35 minus 4 lakh. You get 1941. So 1941.74. So 10,941.74. Yes, this is the answer. See, very tricky. Right, number of days for which Mr. X held the investment. Now this is the point. What was I saying? 38,000 something I got, no? 9.66%. 4 lakhs into 9.66% is 38,640. See, 38,640 if it were to be held for full year. But how much did they actually get? 10941.75. So what is the ratio? 10941.75 divided by 38,650 is 0.28 years. So 0.28317 years into 365. You get 103.35 days. Now you can take it as a round of 103. Is their answer is there. Then number of days for which Y would be held. Now same logic, you have to work backwards for Y. Y ka closing NAV is this much, and what is the dividend that he received? There is no dividend. So what is the yield that they have got? 8 lakhs minus 792,079.21. They have lost 7920.79. This is the money that you have lost. So this you have lost on 8 lakhs. Divided by 8 lakhs. You get into 100. You get 0.99%. You have lost 0.99%. But you are saying actual losses minus 11.66%. So 0.99% is for what day, such that it annualizes to 11.66. So what you do is 0.99, sorry, my 11.66 divided by 365 into x is equal to 0.99. That is for so many number of days, it is 0.9. So you do 0.99 into 365 by 11.6 into 365 divided by 11.66. You get 30.99. So that 31 days. Answer is 31 days. Okay, now let us move to the next one. Case scenario 27. ABC is planning to expand its business and therefore raising funds by issuing convertible bond of 10 crores. Investor is interested to invest in the bond. They are following data. For the data given below, it's the convertible bond. Face value 250, coupon, number of shares, market price, straight value, market price of the convertible bond, maturity. Number of shares and market price, this is 240. Okay. Then the percentage of downside risk. What is downside risk? Whatever is the current rate. What is the current rate? 265. Where can it go down to? It can go down to the straight value. So 30 divided by 265 is 11.32%. Is it there? 11.32 should be the ideal thing, no? 11.32. Now this is a mistake on ICAI's part. I'll tell you what they have done. They have done 30 divided by 235, which is 12.76. See, they have done this. 30 divided by 235. A downside risk is always from the higher value to down, not from a lower value to high. Okay, so this is a unfortunate question. Answer is ideally 11.32. Had they given it, I would have marked that. They have not given it, which is where it showed 12.77. Okay, next, conversion premium. What is conversion premium? If you convert, what is a convertible price? What is a conversion price? See, conversion price is 240. From current market price to the conversion price, what is the difference? Which is about 25. Now this 25 premium is something over and above. So 25 by 240 is 10.416. Is that there at least? 10.416. Then conversion parity price of the stock. See, market price is 265. You get 20 shares. So 265 divided by 20, you get 13.25. That is the conversion parity price. If he wants an approximate yield of 15%, the maximum price he should be ready to pay for. He wants a yield of 15%. So what is the current yield? Coupon rate is 20%. Okay. Now coupon rate is, sorry, not 20, 12%, and face value is 250. The yield keeps going up, the price keeps coming down. And the current straight value of the bond is 235. So basically, it says that it is already yield is higher. So the yield keeps going further up. If the yield keeps going further up, price will go below 235. How much below? What are the options? 232, 240, 224, 217. See, it definitely is not 240. Okay, can it be 232? I have no clue. How do we figure that out? How do we figure that out? See, you then have to value the price of the bond, which is they are getting it at 12 rupees per annum. Now, balance maturity is 5 years. So, 12 rupees is the annual coupon on face value of 250. So, 250 into 12 is how much? 250 into 12% is 30 rupees. So, you are getting this 30 for how many years? For 5 years. At what rate? At 15%. 1, 2, 3, 4, 5. GT, you get 3.352. So 3.352 into 30 plus you get back your 250. So 250 into 1 by 1.15. 1, 2, 3, 4, 5. 0.497 into 250 is equal to M plus, and 3.352 into 30 is equal to M plus. Memory recall, you get 224. Is the answer there? 224? Yes, 224.85, so 224. This is the answer. This is basically you do present value of bond. Let us move to the next question, case scenario 28. Suppose you are a financial consultant and have following 3 clients have approached you seeking advice on investment to be made in securities. All these 3 clients have different background, risk appetite as well as perception of the market. Client A wants to invest in fixed income avenues, therefore is looking for credit rating of securities as well as financial ratios. Client B wants to earn fixed income over a period by holding maturity. He wants to earn by taking more risk. He is more interested in investing in. He believes that the price reflects all information found in the records of past price and volumes. From the information you know, choose the correct answer. The main factor to be considered in selecting fixed income avenue. So, for client A, see, client A wants what? Therefore, is interested in credit rating, financial ratios. So, he's basically wanting security. So, if he is looking at security and safety, I think the risk of default is a very important thing. What does client B want to earn fixed income over a period of time by holding till maturity? If he's going to hold till maturity, right? If he's going to hold till maturity, right? See, risk of default, actually liquidity are important, but his goal is to get maximum return. So, yield to maturity is the best way. In a weak form of efficiency is prevailing in the market, then which approach is best? So in a weak form of efficiency, technical, fundamental, random, none of the above. So if it is random selection, right, random selection works only in strong. Now the question is, semi-strong what works and weak what works? See, in case of a weak market, the data, only past data is reflected, that is past price data and volume data, right? In case of semi-strong, all public data is reflected. In case of strong, even private data is reflected. Now if past volumes and price data is reflected in the price, then weak form of market is what it is. So basically future data is not available. Okay, whether it can be public or it can be private. So then how do you make money? You make money by doing something called as fundamental analysis, where all public data is also not reflected. So if you are aware of public data, you can make money. So answer is fundamental, not technical. Initially I was also thinking it is technical, but then I realized that it is not technical. Then AAES wants to acquire DNF and has offered the following swap ratio of 1:5, that is 0.5 shares of for 1 share of DNF. Now PAT is given equity shares, P ratio, market price. So what is EPS? EPS is equal to your PAT by this is 3, this is 2. Okay, then it is basically PAT by shares, right? Then the number of equities to be issued by AES for acquisition of DNF. So DNF, 0.5 shares for every 1 share of DNF. So 0.5 shares for 1, so 1,80,000. EPS of after acquisition. After acquisition, PAT is 36 plus 7.2 is 43.2 divided by 1.8 plus 12, that is 13.8. We get 3.130. Yes, 3.130. Then equivalent earning per share of DNF would be. So you are getting how many, what is your EPS? Your EPS is 2. But you are getting how many shares? You are going to get half shares. So in this 3.13, your equivalent EPS is in this 3.13, your equivalent EPS is 1.6 divided by 2. If you do 1.565. Earlier you used to get 2 rupees per share. Now you are going to get 1.565 only. Yes. Then if AES Limited, P multiple remains unchanged, expected market price after acquisition. So what is the EPS post acquisition? 3.13. P multiple is unchanged. P ratio is 10 times. So 10 into 3.13, 10 into 3.13, 31.3. Very simple. I don't know why they are giving such simple questions. It's just unnecessary waste of time even thinking about them. Okay, let's go to the next question. During one business meeting of XYZ, one of the members pointed out that while evaluating the performance of any company, one should not only see its operating income but also analyze its capital structure, as well as weighted average cost of capital as well. WACC on the basis of changes based on the capital structure, keeping all of the factors unchanged. He presented data related to 3 companies, Alpha, Beta, Gamma, whose operating incomes are equal but capital structure is different. Following information related to 3 companies. Uniform tax rate is 35%. From information given above, choose the correct answer. WACC of Alpha shall be how much? Now, this is pre-tax, so please be careful. You should compute cost of debt post-tax. So, 16 into 0.65 is 10.4. So, 10.4 and the weight is 80%. Then 26, weight is 20%. 10.4 into 0.8 is equal to M plus. 26 into 0.2 is equal to M plus. Memory recall 13.52. Then EVA of Beta Limited. What is EVA? Again, you have to compute WACC, you have to compute NOPAT and all of that. So this is 13 into 0.65, 8.45, and the weight here is 50%, balance 22%, weight is 50%. So by 2 is equal to M plus 11 M plus. Memory recall, you get 15.225. Now this is WACC. WACC is on what? WACC you apply on invested capital. Invested capital is 20 lakhs. 15.225 divided by 100 into 20 lakhs. You get 30.45 lakhs. This is what? This is capital charge. What is NOPAT? NOPAT is EBIT into 1 minus tax rate, which is 5 lakhs into 0.65. You get 32,500. 32,500. No, this is not 30.45 lakhs, 4,500. See, that is where I made a mistake. 3,04,500. Now EBIT into 1 minus tax rate. 5 lakh into 0.65 is 3,25,000. See, that is where I made a mistake. Now EBIT minus this, you get 20,500. EVA is 20,500. See, you should not make such mistakes. Price of share per gamma. What is price of share per gamma? See, you have cost of equity, debt, shares is there. How will you find out price per share? Let us look at PAT. EBIT is, they gave PE is 11. So what is EBIT is 5 lakhs. So 5 lakhs minus, you have to subtract the interest. Interest is how much? On 20 lakhs, 20% is debt, that is 4 lakhs is debt. On 4 lakhs, you charge 15%, which is 60,000. So minus 60,000 is debt. So you get 4.4 lakhs as EBT. 4,40,000 into 0.65. So you subtract that, you get 2,86,000 as the PAT. That you divide by the number of shares, which is 1 lakh, you get 2.86 lakhs as EPS. Multiply that with 11, you get 31.46. 31.46. Then estimated market cap of alpha. Now, if you have to do market cap of alpha, you again have to find out the PAT and multiply it with the PE ratio. What is the PAT here? You have 5 lakhs. 5 lakhs minus debt is how much? 16 lakhs. 16 lakhs into 16% is 2.56 lakhs. So you subtract that, you get 2.44 lakhs. From that, minus 65%, minus 35%. You get 1,58,600. This is the PAT. 1,58,600 is the PAT. You multiply it with 11 times. You get 17,44,600. 17,44,600. Then EPS of beta. What is EPS of beta? Beta is again 5 beta. The EBT is 5 lakhs minus interest. Interest is on 20 lakhs. You have to compute 50% is debt. So 10 lakhs on 10 lakhs 13%, which is 1.3 lakhs on 1. So you subtract 1.3 lakhs as interest. You get 3.7 as PBT. From that you subtract 35%. You get 3,70,000 into 0.65. You basically get 2,40,500. That over how many shares? By 83,000. By 83,000, you get 2.89. Did we compute it earlier? Yeah, 2.8975. That is the EPS. 2.8975. This one. 2.90 is the EPS. Okay, this is over. Then case scenario 31. Now let us move to the next one. Case scenario 31. On 1st October 23, an exporter enters into forward contract with BNP to sell $100,000 on 31st December 23. So 1st October, 31st October, 3 months at 85.4. Okay, so the exporter is going to sell. So the exporter is going to get proceeds. However, due to request of the importer, he received money on 28th. So he got money 1 month in advance. He requested the bank to take delivery of the remittance on 30th November before the due date. The interbanking rates on 28th November are as follows: spot and premium. Consider 365 days in a year, prevailing prime lending rate, and so on and so forth. The bank may accept the request of the customer of delivery before due date of the forward contract, where the customer is ready to bear the loss, if any, consisting of what? Swap, interest, swap plus interest, fixed charges plus swap plus interest, and outlay of fund. See, now, thing is, whenever there is a upfront delivery or early delivery concept, early delivery what are the charges that you will have? You will not have just swap or interest. You will have actually swap and interest both put together. Okay, but is there any fixed charge also? So if they have mentioned any fixed charge, then it is applicable. Have they mentioned any fixed charge here? Have they mentioned any fixed charge here? No. But fixed charges are definitely applicable. So the answer is D. In case of early delivery, bank shall charge interest at the rate on outlay of funds at rate not less than PLR here. They themselves are given 12%. No, so what is the question? Swap difference. What is swap? You do 1 buy, 1 sell, 1 forward, 1 spot. Now in this case, what are they doing? Initially they enter into a forward buy. The bank can do forward buy. Now what is happening? That buy, they are buying it now itself, and whatever they have purchased, they are selling it off in spot. So they are selling in spot. So this is what bank is doing. If they are selling it off in spot, on the due date of the original contract, they don't have fresh dollars to deliver, so they have to buy a forward. So the swap is the bank is buying something on forward and selling something on spot. The difference between those two. What are they buying on forward? The bank is buying. So the bank buys at 85.27 plus 15, 85.42, and bank is selling at spot. What are they selling it at? Whatever they have today, they are selling it off at spot. When they sell it at spot, they will get 85.22. So the difference is 20 paisa, correct? This 20 paisa is swap charges. 20 paisa for 100,000, which is 20,000, right? Then what is the interest outlay on funds? Interest outlay on funds is what is the change in funds. See, when you enter into a forward contract, there is no funds flow. Funds flow happens only when there is a buy or sell in the market. Now in our case, what have they done? They have purchased something in the market. They have sold something in the market. They've sold it at 85.22, right? Now what else also happened? On that day, they've also made a purchase. They have made a purchase at what? 85.40. That's a purchase. That's an outflow transaction that they have, and or rather on which there's an INR outflow, and they sold it off in the market at 85.22. So that 18 paisa, no, on 1 lakh, 18 paisa, they purchased at 85.4 and sold it at 85.22. They have an 18 paisa excess outflow. This 18 paisa on 1 lakh is 18,000. On this 18,000, you charge 12%, and this is for 1 month. Divide by 12. You get 180 rupees. So 180 rupees is the interest that they will charge, but they say 365 days or something. They said 365 days. So 18,000 into 12% divide by 365 into, they got 31 days early, into 31. You get 183.45. So 183.45 is what this fellow has to pay, is payable by X. Answer is B, payable by X. What is the net inflow? He is going to get at 85.40 into 1 lakh minus 20,000 minus 183. So he'll get 85 lakhs 19,817. This is what he'll get. Answer is C. Okay, next case scenario 32. A US parent company has subsidiaries in France, Germany, UK and Italy. The amounts due and from affiliates converted to common currency and entered into the following matrix. Okay, the treasurer of, this is an important question. I expect this question sometime in 26 or 27. I expect this kind of question in the exam. It can be an MCQ, it can be a full-fledged question, whatever it is. The treasurer of US is suggesting by applying multilateral netting system, and they can save a lot of money from information given about, choose the correct answer. Before applying multilateral, it is necessary to apply bilateral, unilateral or interest swapping. It is necessary to apply bilateral. Through multilateral netting, these transfers will be reduced to how much? So you see what happens. So Germany has to pay 260 and Germany has to receive 360. So Germany has to receive 100,000. Okay, then we look at France. France has to receive 400. France has to pay 80. So minus 80 for France. Then UK has to pay 320. UK has to receive 420. So UK will receive 100. Then Italy has to receive 500. Italy has to pay 500. Italy has to receive 380. Okay, so Italy has to pay 120. Okay, now what is the total transfers now? Through multilateral, transfers will be reduced to how much? So there is one fellow who is going to receive 100 and 100. There are two fellows who are going to pay 80 and 120. So the total payments that will happen will be 200. Answer is 200. The net payment receipts for France shall be how much? For France, I wrote minus 80. Net payment 80. Okay, answer is B. Then net payment for Italy after netting off. For Italy, it is minus 120. Then transfer charges are 0.01% amount transfer, and by applying multilateral technique, there will be reduction in the overall cost of transfer by how much? See, because of doing multilateral netting, you are only paying 200,000, whereas earlier you were doing 1560,000. So you are going to reduce it by 1360 into 0.01%. into 1000. You will reduce charge by $136. Reduce charges by $136. Then moving to the next one. XYZ Limited needs funds for short tenure. Some functional leverage managers suggested about bank rate overdraft option. On confirming from financial department, it was found that the company exhausted its rate limits due to meeting recent contingency requirements. Then CA of X, who's the CFO, suggested floating commercial paper. Accordingly, the following commercial paper are planned. Issue price of the CP is 97,550, face value 1 lakh, maturity period 3 years, issue expenses is 0.15% for 3 months, rating charge is 0.5% per annum, stamp duty is 0.175% for 3 months. The information given above, choose the correct answer. What is the first question? The bond equivalent yield. What do you mean by bond equivalent yield? So this is one very, very important concept which we have not read in our study material. But this particular concept, the ICAI has asked it in one of the RTPs, and they have now asked it in this, case scenarios also. So you see, what is the difference here? 1 lakh minus 97,550, which is 2450. 2450 divided by 97,550 into 12 by 3. You get 10.04%. This is bond equivalent yield. Basically, you are just looking at purely the interest rate. So 10.046, 10.05. Effective interest rate. What is this effective interest rate? This effective interest rate is 10.05% is for a full year. Okay, on a bond equivalent basis, but this is a 3-month bond. So what you do is you compute this per year or per quarter and then do whole power 4. So 10.04 plus 1. Okay, 10.05% divided by 4 plus 1. Okay, then I do 4 into is equal to then I get 10 minus 1. Okay, then I get 10.435 or 44%. So this is the effective interest rate. So basically you are taking it, annualizing it instead of computing it on a simple basis. Okay, this is simple interest, this is compound interest. Then based of effective interest rate of the total annual cost of funds. Here you not only take this value, you also have to consider these other values. So, and they're all per annum. 0.15% for 3 months, so basically it is into 4, that is 0.6% per annum, 0.5% per annum, and this is 0.175 into 4, this is 0.7% per annum. So 0.7 plus 0.5 plus 0.6, you get 1.8. This 1.8 you add to this 10.44. Those you don't again do compounding, simple interest and all of that, plus 10.44. You get 12.24. 12.24 is the effective interest rate of total cost to the company. It's a very weird question. Unfortunate that they've asked it this way. I can't help it, but that is what their intention is. Which of the following cannot be used by bank to meet its short-term requirement? Which of the following cannot be used by bank? They can do call money, notice money. They can use repurchase agreement. Now, certificate of deposit and commercial paper. See, a bank does not issue a commercial paper. No, bank issues only certificate of deposit. So, answer is B. Commercial paper cannot be used. Period of commercial paper ranges from 7 days to 1 year, 14 days to 364 days, 1 day. So, it can range actually even less than 7 days. I have actually done. So, it is 7 days to 1 year. It is not 14 days to 364 days. That is for your notice money and all of that. Okay, very weird question. Then, grow more. An NBFC is in need of funds and sold its receivables to MAC for 100 million. MFC created a trust for purpose calling General Investment Trust, through which it issued securities carrying different levels of risk. Further, the structure also permits GID to reinvest surplus funds for short term as per the requirement. They also appoint third party to collect the money. It will also follow for defaulting obligators. From the information given above, choose the correct one. Securitized instrument issued by GIT falls under what? See, because they are going to reinvest the surplus fund, it is pay through security. Okay, answer is B, pay through security. Answer is B, pay through security. In the above scenario, who is the originator? See, originally the loan is given by NBFC, but they have sold it to MAC. Now, MAC created a trust. So, MAC is the originator. Okay, MAC is the originator. Ideally, Gromor should be the originator, but our material in the past case studies and RTP, they have said that the person who is doing the transaction is the originator. In the above scenario, GIT is what? They have done what to GIT? Created a general investment trust. So they are the SPV. Safeguard Private Limited is a what? A safeguard is doing what? Collection agent. Receiving and paying. Which of the following statements hold true? When YTM rises, PO's security rise. So first one, YTM increase, PO increase. Second, YTM in market rises, PO falls. Then YTM falls, PO falls. Then YTM falls, PO rises. Now the thing is, no, not rise, tend to remain same. So definitely this is not the answer, boss. Okay, definitely this is not the answer. What will happen generally to a bond? When market rates increase, the bond's price fall. Okay, that is normal logic. But in case of an IO and PO, we have to understand other aspects. What is happening when the interest rates increase? People are not repaying their loans early. If people are not repaying their loans early, loans are going to be repaid on time. If loans are they are going to be basically repaying them late. If people are going to repay late, your principal is going to come back to you late and not at the originally envisaged early. There are going to be no prepayments. Then principal is delayed. If principal is delayed, principal is going to come late. If principal is going to come late and the discount rate is also higher, the value of principal comes down. So PO value falls. So the correct answer for this is, if the interest rates increase, the PO value falls. Answer is B. You are a financial analyst at a prominent investment firm and have been tasked with impartially verifying the weak form of market efficiency for XYZ stock index, a collection of diverse stocks. You decided to conduct 3 different tests. First one, you collected daily price changes of stocks, you calculated correlation coefficients, then whether they had significant correlation, you considered price changes to be independent, results indicated auto correlations are close to 0, suggesting past prices do not predict future price changes. Okay. You further investigated randomness, analyzing the sequence of daily price changes. You counted the rules where price changes are consistently positive or negative. You observed number of runs with expected number based on randomness. Find they align closely, supporting that price changes follow a random pattern. So there is there is no determinable pattern. They are random. Then, to examine efficacy of trading strategies on historical price trends, you implement a simple trading rule. The rule involves buying when the price crosses a moving threshold of 5 and selling if it crosses 7%. Over a period of testing, you compute returns generated by trading strategy. Results reveal that returns are not consistently better than random, implying that price trends do not reliably predict future price movements. Okay. After conducting the 3 tests, the evidence supports weak form of efficient market theory for XYZ. You concluded past prices do not reliably predict future prices. From the information given above, choose the correct answer to the following. Test number 1 is serial correlation test. Set number 2 is filter rule. No, not filter rule. Test number 2 is run test. Test number 3 is filter rule test. The filter rule should not be applied for buy and hold if the behavior changes is predictable, behavior changes are random, behavior is correlated, behavior of stock price changes is random. See, let's say if it outperforms buy and hold, right, then the market is not efficient. Okay, not even weakly efficient. But what are we saying? In a weakly efficient market, filter rule does not generate more than your buy and hold. So when will that not generate more than buy and hold? When the behavior is random, not when behavior is predictable. If behavior is predictable, it will generate more than buy and hold. Then it is not even a weakly efficient market. So behavior of stock change is correlated, stock price is random, or behavior of stock price changes is random. So B and D look very similar. Behavior of stock price changes is random. B and D both look same. So answer is actually B, but D is also unfortunately same. The results of your study support the random walk, strong emerging market hypothesis, semi-strong. Now all 3 tests, serial correlation, run test and filter rule test, these are for weak thing. You only said here, somewhere weak form of efficient market theory. So they support weak form. Now what are they saying? Does it support semi-strong? Does it support strong? Does it support market? No. So the stock prices are random. So it supports the random walk theory. Okay, let us look at the next question. Case scenario 36. Bank is in need of fund for a period of 14 days. To meet this financial need on 20th September 23, they entered into an agreement with Bank B under which will sell 10% government bonds issued on 1st Jan 23 at 5.65% for 8 crores. Face value is 10,000 per bond. Clean price is 9942. Initial margin is 2%. Maturity date is 31st December. Consider 360 days in a year. Interest is payable. And based on the above, answer the following. And what is the arrangement? It's a repurchase. Dirty price of the bond is, clean price is 9942. And what is dirty price? Including interest. To meet this on 20th September. So you have to accrue interest for, they have not said whether it is a year or what. It's a 10% bond. So 10% for how many days? 31 Jan plus, and this is which year? 23, right? Plus 28 Feb plus 31, or we can do the other way. 365 minus 31 December minus 30 November minus 31 October minus till 20th, right? So you have 11 days minus 11. You have 262 days. So plus 10,000 rupees bond plus 10,000 into 10% into 262 by 360 into 10,000 into 0.1. You get 727 plus 9942. 10669.7. So 10670. Answer is B. Then the start proceeds of the transaction. What are the start proceeds? How much will you give? So you basically, when you do this start, right, your 14 days interest. You're doing this transaction for 14 days. So the start proceed, clean price is this much. You are borrowing it for 5.65% for 8 crores. So it is an 8 crore face value. Okay, so now the loan value is not clearly defined here. 8 crores is the face value of the bonds that you are borrowing. Now 8 crores is the face value. What is the price? 10,670. So 8 crores or 8 into 1.067. You get 85360. So 8536 is the start, but then you also have this initial margin concept. So it most likely is this. Let me see. 10,670 divided by 10,000 into 8 crores, 7 zeros. So you get 8536 and 4 zeros. So 85360, but you will not get the entire value as the loan. They will, on whatever is the face value of the bond, out of that or whatever is the market value of the bond, they will reduce 2% and give you. So into 0.98. You get 8365280. 8365280. This is the answer that you will get. Answer is not C, it is B. Okay. Second leg of the transaction. See, since you have borrowed this, you have to repay with how many days? At 5.65% for 14 days into 14 by 360 plus that into 5.65% into 14 divided by 360 is equal to plus 83652,800. You get 838,6604. Answer is this. And finally, amount of accrued interest per bond shall be. What is the accrued interest? We just now found out here. No, 670 plus this one, 727. That is the accrued interest. Okay, let's move to the next one. Case scenario 37. Two friends A and N were discussing about risks of market. While A is sort of risk averse, N is aggressive. N said we cannot diversify the market at all, and he quoted modern portfolio approach. Both of these friends analyzed the market data for a few months and came out with the expected return on two stocks for a particular market. Market return aggressive and defensive. From the information given above, choose the correct answer to the following question. So what is this market return? They've said on two stocks. Acha, this is a stock 1. This is stock 2. Okay. The beta of defensive stock. What is the beta? Beta means change in return due to change in market return. That is 9 by 18.5. Very simple. 18 minus 9 is 9. 9 divided by 25 minus 7. Okay. Then expected return on aggressive stock. Aggressive stock, if the market return is equally likely to be 7 or 25. So if this is 50-50, that is this is 50%, 32 by 50 into 0.5, this is 16. So market return is 16. What is this going to be? So this will be 22. Why? It is average of these two. Here also it is average of these two, no? So it will be 22. Then alpha of the defensive stock. What do you mean by alpha? Alpha is actual return minus expected return. Now what is the actual return? Do we know what is the actual return? Actual return is, no, this is not the thing. We should actually compute it this way. 9% is equal to alpha plus beta into 7%, and 18% is equal to alpha plus beta into 25%. Now what is our beta here? Beta we found out for defensive is 0.5. So 0.5 into this is into 7 is 3.5. 9 minus 3.5 is 5.5. Is it coming same here? 5.5 into 25 is 12.5. 18 minus 12.5 is 5.5. So alpha is 5.5. What a weird question. The modern portfolio theory is propounded by Sharp, Black-Scholes, Ross, Harry Markowitz. Answer is Harry Markowitz. As per capital market line theory, the portfolios lying on CML on the market portfolio are called lending, borrowing, diversified or risk-free portfolios. So capital market line is a line like this. Now these are not risk-free portfolios. These are diversified. See, it is lending or borrowing depending on whether it is what is the proportion of risk-free asset and a non-risky asset. So it's actually a diversified portfolio. Yes, it is a diversified portfolio. Then question 38 or case scenario 38. Mr. X on 1st July during the initial offer of some mutual fund invested in 10,000 units having face value of 10 for each unit. On 31st March 22, the dividend paid by mutual fund was 10% and he found that his annualized yield was 153. On 31st December 23, 20% dividend was given. On 31st March 24, he redeemed all balance of so-and-so shares when his annualized yield was so-and-so. NAV as on 31/3/22 shall be. So, see, originally it was 10,000 units. Now, have they given anything? So, there's a thing that you have to work actually. There's a detailed working. So, on 1/7/21, 10 and 10,000, this is the investment. On 31st March 22, 31/3/22, the dividend was 10%. You found. So, here please note everything was paid in terms of new issue of units only. Okay. The whatever dividend was there, it is reinvested as units. See, his closing balance is 11,296.11. Okay. Now, on 31st December 23, 20% dividend was given. On 31st March 24, he redeemed all units. So, you have initially 10,000. Now, dividend paid was 10% in 31st March 22. So, you basically got 10% of this 1 lakh, which is 10,000 rupees. Now, this 10,000 rupees was reinvested as new shares, okay, as new units. And his annualized yield is 153.33. See, if you have invested 1 lakh and your annualized yield is 153.33, it basically means that over 1 year you earned 153.33%. But please note, you have invested on which date? 1st July. So that is only 9 months. So annualized is 153. So for 9 months, how much it is? 153.33 into 3/4. You get 115%. So the actual return is 115%. Absolute return. 115% is the return. So closing value is what? 2.15 lakhs. Now 2.15 lakhs is for how many units? See, what happened? You got a dividend of 10%. Okay, so this 2.15 lakhs includes a dividend of, that's the value, right? So it includes a dividend of 10,000. So 2.05 lakhs is value before the dividend was invested. Now 2.05 is the value, then if 2.05 is the value, how many units did they invest? He invested 10,000 units. Now if you invested 10,000 units at 1 lakh and it became 2.05 lakhs, what is the value per unit? 2,05,000 divided by 10,000. It will be 20.5. So the NAV on 31st March is 22 is 20.5. Okay. Then number of units shall be approximately. Now this 20.5 is 10,000 whatever dividend you've got. Right. This 10,000 rupees was reinvested at 20.5. So that's the dividend that you got. So 487. So you got 10,000 plus 487.8, which makes it 10487.8. Then dividend as on 31/3/23. On these units, you got 20% dividend. So plus 10,000, okay, into 0.2 into 10. You got 20975.6. This is the dividend that you got. And at the year end, at the end of the year, he had closing 11,296 units. That is, he had opening of 10,487, that increased to this much. So 11,296.11 minus 10,487.8. You were allotted 808.31 units. Now, if you are allotted 808.31 units, for how much value? 808.31 units. For how much value? We have the value here, no? Did I write it somewhere? No. So 808.31 units. And what was the dividend? Dividend was 11,487.8 into 2. You got 20975.6. So this is the dividend value. This is the units that is allotted. So what is the NAV? One by the other. 20975.6 divided by 808.31. You'll get us 25.95. That will be the NAV at which allotment has happened. Okay. Then after that, what happened? NAV on 31/3/24. What is this whole 24? He had closing this many units, but the yield was 73.52. So the yield is 73.52. After what? For how many years? He invested in 21. So 21-22 is 0.75. Then 22-23, 23-24. So 2.75 years. So for 2.75 years, yield was 73.52% annualized. Okay. So per annum, it works out to this. So for 2.75 years, how much does it work out to? 73.52 into 2.75. That makes it 202.18. 202.18 into 1 lakh. Divide by 100. So your return is 202,180 plus 1 lakh. So your closing value of your investment is 302,180. 302,180. This 302,180 divided by how many units do you have? 11,296.11. You get 26.750. 26.750 is the NAV. Okay, then if you think I've done this quickly, right, there are two things. One, obviously you also need to speed up. Second thing, even in exam, you will not have time to sit and make a table and all that. It is very important that you save time also. So I know that ICAI asks for stepwise markings, but that stepwise marking is for your theory question, essay type or detailed questions, not for MCQ. So you have to move fast. You can have a look at the solution given out by ICAI, you will understand. I have also solved the same way only. Next, asset management company of mutual fund has declared a dividend of 9.98 on the units under dividend investment plan for the year ended 21. Investors are issued additional units for dividend at the rate of closing NAV for the year as per the conditions of the scheme. Closing NAV was 24.95 on 31st March 21. Investor X, who is having 2,800 the year end, has made an investment in the units before declaration of the dividend at the rate of opening NAV plus an entry load of 0.04. The NAV is appreciated 25% during the year. The face value is 10. From the information, choose the correct answer. Opening NAV is how much? See, closing NAV was 24.95 hours. Okay, investor who having at the year end made investment in the units before declaration of dividend. The rate of opening NAV. So now these are all tricky questions. Opening NAV be X. Okay, now see they have said closing NAV is 24.95. What did they ask? NAV is appreciated by 25%. So 24.95 by 1.25. 19.96. So the opening NAV is 19.96. Simple. Then number of units purchased. See, 19.96 was the opening NAV. But what did you do? Who is having at the year end made investment in the units before declaration of dividend at the rate of opening NAV plus entry load. So plus 0.04. So he is purchased it at 20 bucks. Okay, he is purchased each unit at 20. At the year end, he has 20,800 units. Now 20,800 units is basically dividend, post dividend reinvestment. How much was the dividend that is reinvested? See, the declaration of dividend at the rate of opening NAV plus an entry load, NAV is appreciated, face value is 10. So on 10 rupees, 9.98% is the dividend that is declared. Okay, that dividend our man has invested. So on that, our man has invested at what rate? See, we said opening NAV is 19.96. Now he is invested at 20. Okay, But the number of units at how much money has he put in, that we have to find out. So if you look at this question, right, how much, let opening units be X, okay, and he is invested at 20. So his total investment value is 20X, okay. This is one part is clear. This is opening investment. Then his closing units was 2800. In between there was a dividend. How much was the dividend on this X? Okay, 10 rupees into 9.98%. Whatever is the dividend, this dividend divided by you have an NAV. NAV is what? NAV at the closing only. So 24.95. So you have opening some units, you added fresh units, closing you became 20,800. So 10 into 9.98% divided by 24.95, you get 0.04x. So x plus 0.04x is equal to 2800. X is equal to 2800 by 1.04. You get 20,000. So this X is 20,000. So he initially invested 20,000 units. So what is the question? Number of units purchased? 20,000. Tricky and unique question, right? Original amount of investment. So he invested 20,000 at 20 rupees because 19.96 plus 0.04. So he invested initially 4 lakhs. Which of the following statement about expense ratio is or are correct? It is a percent of income that is spent to run a mutual fund. It includes advisory fee, travel cost, registered fee, custodian fee. It includes brokerage cost for trading of the portfolio. High expense ratio can seriously undermine the performance. See, this is 100% right, boss. Percentage of income that is spent to run a mutual fund. No, definitely not one. It is percentage of assets. Okay, it includes advisory, travel, register, custodian. It includes brokerage. Now, I think there is a very specific term for brokerage, whether brokerage is there or not. So, 2, 3 and 4. So, is there a part where they said 2, 3 and 4? Achha, they are asking which are incorrect. Huh? So, 1 is definitely incorrect. So, 1 is definitely incorrect. So, it is either option 1, it is option A, B or D. Now, A, what is A? It is percentage of income, that is, okay. Then, what is number 3? It includes brokerage. See, it is definitely not this because it includes advisory fee, travel costs, register, custodian fees. So, it is either B or D. Now, the question is, does it include brokerage costs or not? You will know this only if you have studied the material. So, it does not include brokerage cost. Okay, it is only other expenses. So, answer is B because brokerage costs are not included and it is not a percentage of income. Then, dash consider and uses downside deviation, Sortino ratio. This also is a new thing I explained in class. If you're not aware of this is a new concept that they've introduced in the new syllabus where they're saying that there's a concept called downside deviation where you take, instead of taking standard deviation for all the items, you take for standard deviation only for the items that are below the mean. Okay, then you as an investor had purchased a 4-month European call on equity shares of X for 10, of which the current market price is 132 per share and exercise price is 150. We expect the price to range between 120 and 190. Expected share price and probability is given below. From the information, choose the correct answer. Expected price at the end of 4 months. So, share price you can directly multiply with probability. 120 into 0.05 M plus 140 into 0.2 M plus 160 into 0.5 M plus 180 into 0.1 M plus 190 into 0.15 M plus 160.5. Answer is 160.5. Then, suppose if the exercise price prevails at the end of 4 months, the value of the call option. So, at the end of the 4 months, current market price is 132, exercise price is 150, you expect the price to range between 120 to 190. What is the value of the call option? I have a right to buy at 150 and exercise price is also 150 and the market price is also 150. Then what is the value of the option? 0. Then in case the option is held to maturity, expected value of the call. So when you have an expected value of the call, you should not directly take this 160.5. That is the expected value of the share. For expected value of the call, for each point you have to find out what is the value of the option. So at this, I have a right to buy at 150. So at 120, I'll buy in the market 0, 0, 10, 30, and 40. How I got 40? 190 minus 150. I have a right to buy at 150. Market price is 190, so I will buy at 150 and make a gain of 40. So now you multiply this with respective probabilities. 10 into 0.5 is 5, 30 into 0.1 is 3, and 40 into 0.15 is 6. So 6 plus 3, 9, 9 plus 5 is 14. So value of the option is 14 at that particular point. Then in the given different scenarios of expected price of share of X Limited at the time of maturity, the option shall be in the money. So where all is it in the money? Wherever you are making profit, it is in the money in three scenarios. Then in the given different scenarios of expected price of share of X at the time of maturity, the option shall be at the money. Is there any at the money? No, there is no at the money wala logic. Did they say no? In the money, at the money, there is no scenario where there is at the money. So I don't think there is any scenario. You can highlight that only. Then, suppose you are a risk manager at a financial institution. Your company has loaned a significant amount of 500 crores to a company X for a period of 3 years at 6 months at MCLR plus 200 bips. You are concerned about X Limited's ability to repay the debt due to recent volatility. To protect your institution, you intend to purchase a CDS from ABC Bank for the same notional amount, premium quoted 1% through cash settlement, 1% per year, 1% per year. The respective these dates for actual MCLR as follows. From the information you know, choose the correct answer. Purpose of CDS is to protect against default risk of a debt obligation. Answer is be very clear. So the following statements is true. They cannot be used for such speculation. No. They are not governed, are governed by government regulations. No. Are private agreement between two parties? Yes. Then which organization publishes guidelines? ISDA. Assuming no default occurs, total premium company will pay during the designated loan period. See, every year 1% for 3 years on 500 crores. So 500 crores, 1% is 5 crores. 5 crores into 3 years is 15 crores. Suppose if the lender defaults somewhere in the beginning of the third year of the loan after payment of interest up to 2 years, and the market value of reference loan falls to 70% of par value, then ABC Bank will pay you how much in cash settlement. So if you have to pay, if you are going to get 70%, balance 25% they are going to give. So they will pay you 25% of 500, which is 125. XYZ is a mid-sized manufacturing company that produces industrial equipment. The company is considering new investment projects, state-of-the-art automation production line, which is expected to improve production efficiency. The details of the same are as follows. Initial project cost, sales price, cost, sales volume. Applicable discount rate is 10%. From the above, choose the correct answer. Sensitivity helps to identify what? Exact profitability, break-even, degree to which a change in each variable affects the NPV. That is the answer. Sale price, so the project will break even at 0 NPV, with 0 NPV. So now you are supposed to compute NPV, okay, not at each year level. So 20,000 units and their sales price, the price has to change. So 20,000 by into, let's say the contribution is X, okay, by 1.1, 30,000 into X by 1.21 plus 30,000 into X by 1.221. How are you getting 1.1? Because discount rate is 10% is equal to 10 lakhs. It's not 1.221, it's 1.331. See, I shouldn't make that mistake. Okay, so you are discounting each of them and you are going to get 10 lakhs. So what should be the sale price? 20,000 divided by 1.1 is equal to M plus. 30,000 divided by 1.21 is equal to M plus. 30,000 divided by 1.331 is equal to M plus. Memory recall, you have 65514.6. Okay, so 10 lakhs divided by 65514.6, you will get 15.26. 15.26 is the contribution. So because this X what we have is your sale price minus variable cost. This is contribution. What is your sale price? This plus your variable cost of 40. So it becomes 55.26. Answer is 55.26. Then the cost per unit of the product will break even with 0 NPV. Same logic. Here the NPV should be, the contribution should be 15. Sale price is 50. Sale price is pre-decided 60. So the cost can increase. So cost, if the contribution has to be 15.26 and the sale price is 60. So 60 minus 15.26, you will get 44.74. Overall dash in sales volume will lead to the project to break even with 0 NPV. Now, if you look at this, if you maintain, okay, 20,000 into 1 plus X into 20, assuming the same contribution, which is 60 minus 40, okay, by 1.1 plus 20 into 30,000 into 1 plus x by 1.21 plus 20 into 30,000 into 1 plus x by 1.331 is equal to exactly 10 lakhs. Initial cash outflow is 10 lakhs, right? So 4 lakhs divided by 1.1 is equal to m plus, 6 lakhs divided by 1.21 is equal to m plus, 6 lakhs divided by 1.331 is equal to m plus. Memory recall, you get 13 lakhs 10,293 into how much? How much should it reduce? Okay, minus 10 lakhs divided by 13 lakh 10,293.11. It should reduce by 23.68%. Yes, if it reduces by 23.68, then it will fall down from 13.10 lakhs to 10 lakhs. Then your NP will be 0. Now this is the reduction in sales volume. What did they ask? Acha, I marked the wrong answer. See, be very, very careful. 23.68. This is the reduction in volume that will lead to 0 NPV. How much is the increase in outlay? It is exactly ulta. See, if you are having, on a normal basis, you are having 13.10293 as the cash inflows, okay, present value of cash inflows. How much should your project cost increase? From 10 lakhs, it has to increase by 31.029. That is increase of 31.03. See, you see, be very careful. I marked the wrong, I solved it correctly, but I marked it for the wrong question. Please don't make such kind of mistakes. Let's look at the next case scenario 43. You are an investment analyst working for a financial advisory firm. You have been asked to analyze the bond market yield curve to assist your clients in making investment decisions. Yield curve represents the relationship between interest rates and time to maturity for debt securities, usually government bonds. For simplicity, assume the following yield data for government bonds over various maturities. Okay. From the information given above, choose the correct answer to the following. Main characteristic of a normal yield curve is short-term yields are higher than, short-term yields are lower than long-term yields, correct. Okay, please note, when we talk of yield curve, it is not yield to maturity. Yield to maturity is same yield across all periods. Yield curve means if it's a 1-year bond, the interest rate is 3%. If it is a 30-year bond, the interest rate is 7.6%. So, short-term yields are lower than long-term yields is the right one. Then, based on revised yield data, what is the yield spread between 10-year bond and 1-year bond? 7 and 3, 4%. What sort of question is this here? Then, an inverted yield curve. What inverted yield curve is? See, normal yield curve is as time increases, yield also increases. Okay, inverted yield curve is what? It is like this. So, basically it means that the short-term rates are high. Why are short-term rates high? Because rates are high because RBI has increased the rate, or whoever central bank. Why would have they increased the rates? Because inflation is very high. So, inflation is high means the country is at a some kind of a bubble. Okay, economic growth and certain upcoming recession, inflationary pressure indicates there is inflationary pressure. So, an inverted yield curve would mean, see, it is because of inflation they are doing, it is not inflation pressure, it is actually the next, what is going to come is an upcoming recession. Okay, then if investors will invest 2 years, starting 3 years from now, the forward rate would be 2 years, 3 years from now. So, after 3 years for next 2 years, that is 1.06 power 5 by 1.05 power 3 under root. Okay, 1.06 into 1.06 into 1.06 into 1.06 into 1.06 divided by 1.05 divided by 1.05 divided by 1.05, you get something for that square root, 7.517, so you can take it 5.2. Investor is looking to invest for 2 years starting 5 years from now. What a horrible question here. 5 years from now, 2 years. So, 1.064 into equal to 1, 2, 3, 4, 5, 6, 7 divided by 1.06, 1, 2, 3, 4, 5 for this square root, 7.41%. Then, next, following financial data is available for financial year so and so. Debentures, bonds, equity shares, reserves, total assets, asset turnover, effective interest rate, effective tax rate, operating margin, dividend payout, current market price, required rate of return. From the above, choose the correct answer. 10% bonds must have been issued in which month? See, 10% bonds are 50 lakhs. So, at the end of financial year ending 23. So, they were issued ideally what should be the interest? Interest should be 5 lakhs. But what is the interest? Effective interest rate is only 8%. Effective interest rate is 8% on a 10% bond means it is 80% of 12. 12 into 0.8, 9.6. So it is 10 months bond. 10 months bond means at March it is finishing 10 months. So it would have been issued in June 22. Now some of you might be wondering, sir, why did you not consider this 8% debentures? 8% debentures have the same thing as effective interest rate of 8%, which is why I ignored. You can combine both of them and also do, then also you'll get the same answer. But moment I looked at it, there is only this bond which has a different ratio. So this 8% debentures and effective interest rate of 8% means they both get cancelled. The entire problem is because of this. You can also do that thing also. 125 into 8% plus 50 into 10% into x by 12 divided by 175 is equal to 8%. That's what I made a mistake. So 8% of 175 into 8% is 14. So this whole thing is equal to 14. What is 125 into 8% is 10. So this balance is 4. Ideally it should be 5. Why? Because 10% on 50 is 5, but it is only 4. So basically it means that it is 80% of the time is what it is there. 80% of the time in a year the bond was outstanding. Why? Because 80% of the interest is what is accrued. So 80% of the time it is outstanding means 80% of 12 months is 9.6 months. If it is 9.6 months, it would have been issued in June. Okay, then amount of retained earnings for the financial year. What is a retained earning? See, you have operating margin, dividend payout. Operating margin is 10%. Asset turnover is so and so. So what is equity and debt? Equity is 400, debt is 175, total is 575. So total of assets is also 575. No, total of assets is 600. So they had some other thing here. So total of assets is 600. They probably had some other liability, some current liability or something at 25. Okay, asset turnover ratio. So asset turnover ratio is total turnover divided by asset. So turnover is 660. On that your operating margin is 10%. Which is 66. From that you subtract interest. Interest is how much? 8% on your 175. 175 into 0.08. You have 14. So you subtract 14, you get PBT, which is 66 minus 14 is 52. So from 52, you subtract 40%. So into 0.6 is 31.2. Out of this 31.2, you pay off 16.67%. Divided by 6 minus 31.2 minus 5.2, you get 26. 26, see, small mistake. Return of equity. What is ROE? ROE is PAT by equity capital. 31.2 is PAT, and what is equity capital? Your equity plus reserves 400 is 7.8%. Then sustainable growth rate. What is G? B into R. B is retention ratio, which is 83.33%, and R is your ROE, which is 7.8. That is 6.5%. Fair price using dividend discount model. D1 by KE minus G. What is current year's dividend? Current year's dividend is you have 5.2 as dividend paid. Correct? No, 31.2 minus 26, 5.2. But what is shares? Do we have share count? You have 100 lakhs worth of equity share capital of 10 rupees each, so 10 lakh shares. So 5.2 is dividend and 10 lakhs is shares. So 5.2 lakhs divided by 10 lakhs is 0.52. So D0 is equal to 0.52. D1 is equal to 0.52 into 6.5%. 1 plus 6.5. Into 1.065, you get 0.5538 by KE minus G. G is 6.5%. Cost of equity is 15%. So 0.05538 divided by 0.085, you get 6.515. So 6.5 is a fair price per share. Then scenario 45. An Indian exporting firm, Rohit and Bros, exported goods worth AUD 1 million to an importer in Sydney. They are worried about likely depreciation in future. So India, we exported to somebody and depreciation of they're worried about, see, they're worried about depreciation of AUD, that is appreciation of INR. If INR appreciates, they'll get lower money in INR. They're worried about depreciation in near future. Likely the export sum will be received after 3 months, as there is no derivative available to hedge from depreciation. Spot rate is so and so. 3 months interest rate in India and Australia. From the information given above, choose the correct answer. Dash heading can be used to hedge itself, money market. If there is no derivative, then money market. Suppose they want to borrow some money in AUD such a manner that the receivable amount can be used to repay the loan along with interest. The amount to be borrowed by Rohit shall be approximately how much? You will borrow so much that post interest it will become 1 million, because you're going to receive 1 million. It is for how many months? After 3 months. So, and Australia interest rate is 5%. So, you will borrow 1 million by 1.025. 1.0125. Why did I get 0.0125? 5% is the interest rate for full year. So, for quarter year, 1.25%. So, what 1 million you will borrow, but not exactly 1 million, lesser than 1 million, such that the repayment has to be 1 million. So, 1 million by 1.0125, you will get 987,653. 987,654.3. Okay, then suppose they borrow a designated amount in USD for 3 months and manner that receivable amount can be used to repay along with interest and plant interest, the same amount in spot. The amount available for investment shall be, you have this much in AUD. What is the current spot rate? 56 rupees per AUD. So you multiply this with 56. You get 55308642. 8624. I got it 8042 because I did not round it off. If you round it off, you'll get this. Then, if Rohit borrowed designated amount for 3 months and manner that receivable can be used to repay along with for the plans to invest the same in Indian stock market, the amount obtained after 3 months. So, if you are going to invest this and you are going to get how much interest? You're going to get interest of 12%. So, 12% per annum for 3 months into 1.03. You get 5696. Yes, this one 56967883. Then, suppose if the interest rate parity is between INR and USD, then forward rate is, this should be the forward rate, 56.967. 56 point. Achha, for 6 months, see, be very careful. I had asked the question for 3 months. 3 months rate is 56.96. So, how do you do this? You do this as 1.1 plus 12% by 2 whole by 1 plus 5% by 2 whole thing into 56. So, 56 into 1.06 divided by 1.025 is 57.91. Yes, 57.91. Next, Mr. B is a rational risk taker. He takes his position in single stock for 4 days in a week. He does not take position on Friday to avoid weekend effect and takes position only for 4 days, Monday to Thursday. He transfers amount Monday morning, withdraws balance on Friday morning. He decides to take maximum exposure in single stock, not the portfolio, where VAR should not exceed the balance lying in his bank account. Positioned by his manager as per standing instructions, taken on free balance lying in the morning. Before opening bank account, he has transferred 11 crores to his bank account. Fixed deposit also matured. The matured amount was also credited to his account. However, Mr. B received intimation of the same in the evening. Bank needs minimum balance of 1,000 at all times. Other information. Amount available which can be used for 4 days. So, you can actually use the entire money, boss. That 11 lakhs and 11 crores and 63, 42, 41, 560, because he has to keep 1,000. 63, 41, 560. So, if you remember in one of the case studies, they didn't give this as an option. So, we were forced to take other option, which is not ignore the money that came as maturity of the deposit. Z score and 99 confidence for is how much? At 99% confidence level, what is the Z score? I think it is 2.33. 2.33. The expected return for the stock X. What is the expected return for stock X? 6 into 0.1 is equal to M plus, 7 into 0.25 is equal to M plus, 8 into 0.3 is equal to M plus, 9 into 0.25 is equal to M plus, 10 into 0.1 is equal to M plus. Memory recall, you get 8. Expected return for Y. I think Y is also 8 only. 4 into 0.1 is equal to M plus, 6 into 0.2 is equal to M plus, 8 into 0.4 is equal to M plus, 10 into 0.2 is equal to M plus, 12 into 0.1 is equal to M plus. You get 8. In which stock should you invest to maximize returns while maintaining its value at risk? So, which stock should you invest? See here, out of these stocks, no, this stock has 8, 8, 8, 8, 8 as the average. This also has 8, 8, 8. But if you see the second stock, it has higher volatility. If you have higher volatility, you have to maintain higher VAR. Okay, so because there is highest volatility, higher risk. So in which stock should you invest to maximize returns and maintaining its value at risk within acceptable limits? So stock X is suitable because it has lower standard deviation. You can also look at it as coefficient of variation, which is standard deviation per mean return. Whichever has higher standard deviation per same return, you should ignore that. And whichever has lower standard deviation for given return, you should consider it. XYZ plans to invest 8 lakhs in a new unit. The project is expected to have a useful life of 4 years with no salvage value at the end of its life. The annual depreciation project is 2 lakhs. The projected revenues are given below. It's subject to corporate tax rate of 60%. Cost of capital including premium is 10%. Depreciation is so and so. Depreciation benefit for the project per year. 2 lakhs into 60%, boss. 1,20,000. Inflation adjusted revenue for year 2. So 7 lakh into 1.1 into 1.09. $839,300. Total cash flows in year 1 after adjusting for inflation and tax benefit on depreciation. So you have first year 6 lakhs into 1.1, 6 lakhs 60,000 M plus. What are the cost? 3 lakhs into 12%. 3 lakhs into 1.12. 336. So I do M minus. So I get memory recall 3,24,000, which is the revenue minus cost. From that, is there any other cost? No. From that, I subtract depreciation. What is the depreciation? Minus 2 lakh. So I get 1,24,000 as PBT. From that, I subtract tax into 0.4. So I get PAT as 496,000. 4,96,000 plus I'll add back depreciation of 2 lakhs. So I'll get 2,49,600. Yes. Inflation adjusted cost in the year 2. What is inflation adjusted cost? 1.12 into 1.1 into 4 lakh is 492,800. Present value of cash flow for year 3. Horrible fellows here. Okay. 8 lakh is revenue into 1.1 into 1.09 into 1.08. You get 10 lakh 35,936. This is the revenue. What is the cost? 4 lakhs into 1.12 into 1.1 into 1.09. You get minus 537,152. So you get difference of 498,784. Depreciation 2 lakhs. You get 298,784. PAT is 40%. $1,19513.6. Add depreciation 2 lakhs. So plus 2 lakhs. You get 3,195,136. This divided by, you need to be present valued at cost of capital of 10% by 1.1123. 240055. 24. This looks closest to that. 240055. I did everything directly on calculator. I didn't do any rounding off of numbers. So probably which is why I got a different answer. Next, an investor is evaluating two companies A and B to determine which is better. Both have different expected return standard deviations in betas. A has a return of 22 and standard deviation of 40%. Its beta is 0.86. B has expected return of 24, standard deviation of 38% and beta of 1.24. Coefficient between returns is 0.72. Standard deviation of market is 20. Choose the correct answer. Portfolio's expected rate of return. Investor invests 30% in B and 70% in A. 70% of 0.22, 22 into 0.7 is equal to M plus, then 24 into 0.3 is equal to M plus, memory recall 22.6. Standard deviation of investor portfolio, 30% invested in B and 70% in A. Now, what is the standard deviation? Standard deviation is A plus B whole square wala formula. That is W1 sigma 1, 0.7 And what is the standard deviation? In 0.4 whole square plus 0.3 into 0.38 whole square plus 2 into 0.7 into 0.3 into 0.4 into 0.38 into 0.72 under root of this whole thing. 0.7 into 0.4 is equal to into 0.28 is equal to m plus 0.3 into 0.38 is equal to 0.114 into 0.114 is equal to m plus 2 into 0.7 into 0.3 into 0.4 into 0.38 into 0.72 is equal to m plus. Memory recall, we get 0.1373608. If you take under root of this, they're asking you what standard deviation. Under root is 37.06%. Answer is 37.06. Okay, then covariance between returns of stock A shall be approximately. What is the covariance between those two? So what is the formula? Formula is actually, forget these weights, your standard deviation 1 into standard deviation 2 into R standard deviation 1, standard deviation 2. This actually gives you covariance. So 0.4 into 0.38 into 0.72, 0.10944. Correct. Then based on the data given, the risk-free rate of return shall be approximately how much? What is the risk-free rate of return? What is the return of the market? We've got standard deviation of market. We don't have return of the market. So 22%, which is return of stock A, is equal to RF plus 0.86 into RM minus RF. And next one is 24 is equal to RF plus 1.24 into RM minus RF. We have to bloody solve this only. This is a useless equation here. What sort of horrible setup is this? So I'll multiply this with 1.24. I'll multiply this with 0.86. So 22 into 1.24 is equal to 27.28 is equal to 1.24 RF plus 0.992 RM minus 0.992 RF. This is first equation. Other one is 24 into 0.86. This will be 20.64 is equal to 0.86 RF plus 0.992 RM minus 0.992 RF. See, now you subtract one from the other. So these two will get cancelled. Then what is 27.28 minus 20.64? You get 6.64 is equal to 1.24 minus 0.86, 0.38 RF. 6.64 divided by 0.38. You get 17.47. Finally. Then if this is 17.47 or 48, what is the RM? That you can directly find out. You can input RF here. So let us solve using this equation. 22% is equal to 17.48 plus 0.86 RM minus 0.86 into 17.48. What is 0.86 into 17.48? 15.0328. This is minus plus 17.48. You get 2.447. That you take on the other side. Plus 22. You get 19.55. So 19.5528 is equal to 0.86 RM. So RM is equal to this divided by 0.86. You get 22.74. 22.74. Okay. Let us look at the next one. Case scenario 49. XYZ, a US firm, will require $300,000 in 180 days in evaluating different strategies to hedge against the currency risk. The available market data is showing as follows. Current spot rate is $2 per pound and 180-day forward is $1.96 per pound. Borrowing rate, deposit rate, all that is available. Call option, exercise price, premium. XYZ has forecasted the following probabilities. From the information you know about, choose the correct answer. Expected dollar amount need if XYZ does not hedge. If you do not hedge at all, what is going to happen? This is what is going to happen. Spot rate can be 1.91 into 0.25 is equal to M plus, 1.95 into 0.6 is equal to M plus, 2.05 into 0.15 is equal to M plus. Memory recall 1.955. This is the rate of what? How many pounds per dollar, right? This is the rate of, no, how many dollars per pound. So you will require to pay 3 lakh pounds. So you will require this many $1.955 per pound. So you into 3, you get 5.865. Yes, answer is this, D, 5.865. If XYZ choose the forward contract, the expected dollar amount after 180 days shall be. Forward rate में क्या है? What is the rate? 1.96. So 1.96 into 3. $5.88. Under the money market hedge, approximately how much money will they require to repay after 180 days? You are actually requiring to pay pounds. So you will put a deposit of pounds, meaning you will convert your dollars into pounds, meaning you're borrowing in dollars. So how much will you borrow in dollars? And see here also, secondly, the question, is this per annum, not per annum? They have not used the word per annum. So we have to assume it is not per annum. So you need to repay your deposit needs to mature and you needs to get 3 lakh pounds after 6 months. So if you get 3 lakh pounds after 6 months at 1.045, because that is the deposit rate in UK, you will have to make a deposit of 287,081 today. This 287,021 today, what you have, 081, what you have, you are going to actually borrow it in dollar terms. So into 2, because current spot rate is this, which is 574,162. This is the dollar borrowing. This dollar borrowing, what is the repayment that you have to pay? You have to repay it in 1.055 because that is the borrowing rate. You get 605,742. Is that there? See, 605,742. Then if they choose the call option after 180 days, total cost in dollar inclusive of interest and premium shall be how much? So if you choose the call option, right, you have a right to buy at 1.97 dollars per pound. So if the market rate is less than 1.97, you will use this only. So 1.91, 1.95 and 1.97 into 0.25. So 1.91 into 0.25 is equal to M plus, 1.95 into 0.6 is equal to M plus, 1.97 into 0.15 is equal to M plus. You do memory recall, you get 1.943. This is the cost, this is the, if you take an option, this is the cost. But how much are you going to pay? 0.04 plus 0.04. So you're going to pay 1.983. What are they saying? Choose the call option, total cost in dollar for so and so, into 3 lakhs. 594,900. Is it there? 594,900. 594,900. What else have they added? See this option, call option, you pay in advance. So 3 lakhs into 0.04, which is $12,000 you pay in advance. On that you have to pay interest. Interest is what? 12,000 advance for 6 months. 6 months you are paying it in which terms? In dollar terms. Dollar terms borrowing rate is 5.5%. 12,000 into 1.055 or 0.055. $660. So you also have to pay $660 as interest plus 660 makes it 595. See, that is how they got it. Interesting point. Then expected spot rate per dollar after 180 days shall be approximately. What is the expected spot rate? I think we computed here, no? 1.955 or something. 1.96, right? 1.96. Then P Limited is planning to borrow an amount of 60 crores for a period of 3 months in the upcoming 6 months. The current interest rate is 9%, likely to go up in 6 months. The company wants to hedge itself. CFO has been asked as traditional as well as modern methods. Suppose the banker is quoted following FRA. You have issued a redeemable bonds. I don't know what is the meaning of this redeemable bonds or debentures. From the information, choose the correct answer. Which of the following shall be applicable for FRA to hedge the interest rate risk if they adopt this method? So you are going to borrow, what kind of contract is this? For a period of 3 months after 6 months. So this is a 6 into 9 FRA and you are going to borrow. So 9.3%. So answer will be 9.3. Then if the actual rate of interest after 6 months has to be 9.6, what is the settlement amount? So on 60 crores, 3%, that makes it 18 lakhs. 18 lakhs by 2 because it is for half year, not by 2, by 4. By another 2. 4,50,000. 4,50,000 because the loan is only for 3 months, no? By 4,50,000. And see, you need not solve everything. Who's good, who's smarter? The company is smarter. So company is going to receive money. 4,50,000 we already got. Shall be paid by banker. So answer is C. Okay, answer is C. If actual interest rate happens to be 8.8. 8.8 minus 9.3 is 0.5%. 0.5% into 60 crores divided by 4 is 7,50,000. This 7,50,000 this fellow has to pay. So here also you need not bother about anything. 7,33,000 has to be paid by P2, its banker. Why are these numbers 439, 733? Because you also discount them by this 9.6% and 8.8% for 3 months. Then which of the following technique is not a modern technique? Future option swap forward rate. Forward rate is not a modern technique. This is a big lengthy thing. Let us look at the questions directly. Concept of sustainable growth rate. Who introduced sustainable growth rate? Harry Markowitz, Higgins. This one I need not read the paragraph. Sustainable growth rate represents rate at which company can grow by issuing more equity, maximum rate of growth that can achieve without borrowing additional funds, growth rate by demand, growth rate by inflation. So maximum growth in sales that can be achieved without borrowing any additional funds. I have not even read the case study because it was looking so big. I thought let me go down. Then according to the case scenario, risk associated with growing too quickly. What is the risk associated with growing too quickly? Not able to retain staff, could face liquidity issues, stock price might decline, reduce market share. I think due to liquidity due to over expansion, but let us see. So company must ensure operational financial policies goals. They must expanding too quickly to lead to financial resources, leading to excessive borrowing, must also consider long-term implication of resource consumption. Okay, risk of relying on external financing due to excessive expansion, but realizes growth might not be financially sustainable. So it is this one only. It is our liquidity issues. It is our liquidity. Which are the following cornerstones, twin cornerstones for them to achieve sustainable growth? Twin cornerstones are building growth capability along with growth capability and growth. Inflation condition, if creditors require the XYZ historical cost to remain constant, the inflation increase sustainable growth rate, lower sustainable growth rate has no effect. No, it lowers sustainable growth rate. No, if you have increased inflation and you want to maintain historical cost debt to equity ratio, what will happen is more and more money needs to be pulled out of equity. So answer is C. See, I have not actually read the paragraph, directly moved. Then Company X proposed to take over Y. Chief Executive thinks they always look at EPS. He considers maximization of earnings. The following information is available. 80 lakh net profit, PE, current market price. So what is EPS? EPS is 4 and 8.5. If this is the thing, then share count. 80 lakhs by 4 is 20 lakhs and 15.75 divided by 8.5 is 1,85,294. Okay, if the company borrows funds at 15% rate of interest and buys out target company paying cash, how much should it offer to maintain EPS, assuming tax rate of 30%? So the revised EPS should be same. So basically, what is old EPS? Old EPS is 4. Revised EPS also should be 4. What is revised PAT? Revised PAT is these two, 80 plus 15.75 minus your 1 minus tax rate is there? No tax rate. Tax rate is given 1 minus 30% into 15% of borrowing divided by original share count of 20 lakhs is equal to 4. You have to basically solve for this particular equation, right? So how much are you going to borrow on that 15%? Out of that you subtract the tax impact and the whole thing you subtract from the total net profit. So 20 lakhs into 4 is 80 is equal to, here 80 gets cancelled, So you get 15.75 minus, so you get 15.75 is equal to 15% of borrowing into 70%. So 15.75 divided by 0.15 is equal to this, divided by 0.7 is equal to this. So borrowing is 150 lakhs. Borrowing is 150 lakhs means, yeah, how much should it offer? 150. Okay, this is a quick way to solve it. You can solve it slowly, easily and all that, but I would suggest to move faster. Okay, this is actually a past exam question also. A maximum exchange ratio which company should offer so the company could keep EPS. So EPS is at 4. So revised share count is your 20 plus 1,85,294. So no, I don't know the new shares. But profit is how much? Profit is 95.75. 95.75. So the new shares we don't know, but EPS is same. So 95.75 divided by 4 is equal to 23.9375. So you cross multiply, minus 20 is equal to 3.9375. So you're going to give 3,93,750 shares instead of 1,85,294 shares. So what is the swap ratio? 185,294 is to 393,750. 393,750 divided by 185,294. 2.125. Is it there? Yes, 2.125. Next, number of shares shall be 3,93,750. I just now did that. Okay, next, following options related to different action taken in different situation. Excised lapse. Now spot is 160, excise price is 140. Who excised? I have a right to buy at 140. So this is a call. Spot is 175, excise is 200. So this is a put because that is why excise, so that I can sell it at a higher price. Spot is 400, excise price is 300. I have a right to buy it for 300. I didn't buy. So this is basically a, if it were a call, I have a right to buy at 300. Market price is 400, but it is not a call. So it's a put. I have a right to sell at 300. Market is 400. So this is also a put. In situation, the investor position and amount of profit and loss. It is a put option. Now 70 put option and the premium paid is lost. 25 is the loss. Put option 25. Now there is no concept of long short position. Okay, please don't get confused. Situation 1, investor position, amount of profit or loss. Situation 1, 20 rupees is the profit and premium is 20. So net 0. Call option and 0. Then in situation 2, investor position, amount of profit or loss. Situation 2, it's a put and 25 is the gain and 15 is the thing. So 10 is the net profit. Put and net profit. So here they're asking net profit only. Okay, that is why I took in question number 2 and question number 3, both of them net profit. If question number 3 had been gross profit without the premium, then I would have to go back and change answer for question number 2 also. I have to be very careful. Then following information is available with respect to bond A and B. Face value 1,000, coupon rate 6 and 10, time to maturity 5 and 3, investors portfolio consists of 75% of A and 25% of B, YTMs are so and so. Answer the following. The price and duration of the bond B shall be approximately. What is the price of the bond? See, present value interest factor annuity 1,000 at 10% for 3 years and present value interest factor 1,000 into 10%. 1,000 into 10% is 100, 10% for 3 years. Present value interest factor of 1,000 at 10% after third year. 1.1. That's the thing. Achha, they already gave. So these three they have given. 0.7537513. 0.7513 plus 0.8264 plus 0.9091. Cumulative value is 2.4868 into 100 is equal to M plus, and 1,000 into 0.7513 is equal to M plus. Memory recall 999.98. So see, I should not have done this also. See, yield is 10% and coupon is 10%. Yeah, why did I do this? Price is 1,000, very clear. Price is 1,000. Now the point is what is the duration of the bond? Whether it is 2.74 or 2.49. What is duration? Present value, time, cash flow sum of all of this divided by price. So what is present value factor? 0.9091, 0.8264, 0.7513. Period is 1, 2, 3. Cash flow is 100, 100, 1100. What is sum of all of this? 0.9091 into 100 is equal to M plus 0.8264 into 2 into 100 is equal to M plus 0.7513 into 3 into 1000 in not 1000 1100 is equal to M plus memory recall 2735.48 divided by 1000 it will be 2.74. So answer is B, 2.74. Then price and duration of bond A. What is it for bond A? I can directly find out the price, boss. This is 6%, no? This is simpler, man. If the yield is, market yield is higher and my coupon is lower, so I am giving a lower coupon and market yield is higher. As interest rate goes up, price comes down. So here price has to come down. So this is definitely not 1227. Let us see what is it. It is a 5-year bond here. Horrible. Okay, 0.9091 plus 0.8264 plus 0.7513 plus 0.6830 plus 0.6209. Add all of them, you get 3.7907 into 60 is equal to M plus and 620.9 M plus. Memory recall 848.342. See, this is the answer, 848.342. Okay, then price sensitivity of the portfolio. What is price sensitivity of the portfolio? Please note price sensitivity. So what is sensitivity? Sensitivity is, it is Macaulay or modified. Sensitivity refers to modified. You have to be very, very careful. So first you have to find out the Macaulay of the Macaulay duration of the portfolio, then divide by 1 plus yield. What is Macaulay? Here we got 4.41. 4.41 is bond A and how much percentage is it? 0.75. And for the other one it was 2.74 into 0.25. 4.41 into 0.75 is equal to M plus 2.74 into 0.25 is equal to M plus. Memory recall, you get 3.9925. But this is what? This is weighted average duration. This is not the sensitivity. This is the time taken. Sensitivity is divided by 1.1. Why 1.1? Because your yield is 10%. Modified duration is Macaulay duration by 1 plus yield. So this will be 3.629, 3.63. This is a good one. This is a very good one. Then Z paid dividend of 5 for the current year. Dividend is expected to grow at 25% for the next years, 10% thereafter. The return of the government bond is 13%. Market return is expected to be 20%. The correlation between market return and share return is point so and so. The standard deviation of market and Z share is 12 and so and so. Round of calculation. What is the expected return of Z Limited? What is expected return? Expected return is risk-free plus beta into MRP. What is market return? Have they given market return? RF is 13%. Market return is 20% minus 13. Do we have beta? No, beta is not there. Beta we have to find out. Correlation is equal to 0.3733. Standard deviation of security is 12%. Standard deviation of market is 18%. Beta is equal to 0.3733 into 0.12 by 0.18. That is 0.24886 into 0.07 plus 0.13. You get 14.74. I didn't get anything else. Array, see, I made a mistake. I wrote ulta. This is why you have to be careful. What is the Z Limited is 18 and market is 12. So beta is not this. Beta is 0.3733 into 18 divided by 12. You get 0.55995. Okay. Into 0.07 is equal to plus 0.13 is equal to 16.92%. Is it there? Yes, this is there. The intrinsic value of Z shares. This is a nuisance here. And current value of shares is 315 and stock is undervalued, overvalued. So only if you find out this, we can find out this. This is a horrible thing. Okay, anyway, let me see. What is it? First year is 0, 1, 2, 3, 4, 5, 6, 7. First year is 5. 5 into 1.25 is equal to 6.25 into 1.25 is equal to 7.8125 into 1.25 is equal to 9.7656 into 1.25 is equal to 12.20 into 1.25 is equal to 15.26 into 1.25 is equal to 19.07 into 1.1 is equal to 20.98. Then this is dividend, present value 1 by 1.1692 is equal to 0.855 is equal to 0.731 is equal to 0.626 is equal to 0.535 is equal to 0.458 is equal to 0.391. Okay, then is equal to 0.335. Okay, this one may not be required, but I'm generally doing. Now 6.25 into 0.855 is equal to m plus, 7.8125 into 0.731 is equal to m plus, 9.7656 into 0.626 is equal to m plus, 12.2 into 0.535 is equal to m plus, 15.26 into 0.458 is equal to m plus, 19.07 into 0.391 is equal to m plus. Memory recall, all of this put together is 38.14. Now last year's, no, you have to arrive at how 20.98, which is the D1 for that year. So basically you are arriving at the value at the end of this period by KE minus G by 0.692. 0.692, 16.92% minus 10% because it is growing by that way. So 20.98 divided by 0.0692, you get 303.179, but this is the value at the end of 6th year. So you multiply this with 0.391, you get 118.54. To that you add 38.4, you get 156.68. Do we have that as the answer? See, we have that. Horrible. If intrinsic value is this, current market price is 315, obviously the stock is overvalued. What a painful question, man. What a painful question. Then last question. SM Limited has market cap of 3000 and the current earnings per share is 200 with a priced PE ratio of 15. If EPS is 200, PE ratio is 15, then MPS is 3000, meaning share count is 1 crore. Okay. The board of the directors considering proposed to buy back 20% of the shares. So that is 20 lakh shares at a premium which can be supported by financials. The board expects post buyback price to be 3057. So 3057 into post buyback PE ratio will remain the same. Company proposed to fund the buyback by varying 8% bank loan. What is PE ratio divided by 15? EPS is equal to 3057 by 15 is 203.8. Wait a minute, they themselves said 20 lakh shares are bought back. So how many shares are bought back? I need not answer all of this, 20 lakhs. Directly I can answer 20 lakhs. The interest amount which can be paid for availing bank loan. Now interest will come there. I have an EPS of 203. This 203.8 is what EPS? Post buyback EPS. Why is it 203? Because they said the share price is 3057, P is going to remain at 15, so EPS is this. Okay. Then what is my PAT? Original PAT was 200 crores. 200 crores is PAT. So 200 CR minus 8% of loan into 1 minus 30%. What will be? This will be my revised PAT. This revised PAT divided by 80 lakhs, okay, will be 203.8. Now we have to find out the loan value. So 203.8 into everything is in crores, right? 203.8 into 0.8. I get 163.04 is equal to and I'll move 200. 200 minus 160.04 is equal to 163.04 is equal to loan into 8% into 0.7. 200 minus 163.04 is equal to divide by 0.7 divided by 0.08 is equal to loan value, which is 660 CR. Now 660 CR is the loan. Then what is it that they asked? What is the interest on 660 CR into 8% is 52.8 CR. 52.8 CR is, if you do into 100, 5280 lakhs. Okay, loan amount is 660 lakhs. We just know 660 CR, which is 66,000 lakhs. Premium per share. See, you have purchased how many? 20 lakh shares at 660. Basically, you are purchasing it at 3,300. So, what is the premium? 10% or 300 rupees. Because current market price is 3,000, no? Right? Then, premium over current market price 10%. Yeah, what a simple question. Okay, so only complication is once you are in this part, and I am purposely doing it like this because, not doing it very, very clean, neatly, because I also want to proceed fast. In exam also, you have to do things faster. You cannot put a table, write slowly and all that. Only one question I had to do where I had to put the numbers, but everything else in the last 56 questions, I have not touched it. Okay, I have not taken any additional page. Okay, so this concludes all our case studies. Okay. So now please go through this video. I have also released a video on RTP. Please go through that RTP video as well and prepare very well for your exams. In case you have any doubts, please feel free to reach out to me. All the very best.